Of major political turmoil ahead in the new year, and what does this mean for investors?
Plus, both FedEx and General Mills reporting weaker demand in their latest earnings. Both companies cut their fiscal full-year forecast as a result, sending shares falling in pre-market.
And a leadership shakeup at Alibaba, the company's CEO taking charge of the tech giant's e-commerce division. The move, it comes amid growing competition from rival PDD, Pinduoduo.
As we look ahead to the 2024 presidential election, Colorado is looking to leave off one name on its ballot. The state's highest court ruled that Donald Trump's name could not legally appear on the campaign ballot, saying the former president's actions on January 6, 2021 leaves him disqualified under a section of the 14th Amendment. The ruling now leaves the Supreme Court decision front and center as we enter a big election year. Yahoo Finance's Rick Newman joins us now with the details. Rick, this news coming out really just in the last 12, 18 hours here. Just curious your overall takeaway and maybe shock factor here.
First, I think it's unexpected. There were two similar cases trying to do this in Michigan and Minnesota that basically failed. One of those is on appeal, but I don't think there was much expectation it would go anywhere. So the question now is, will this stand? And I think this is an example of some of the wild cards that could pop up in the 2024 election. So what happens next here is the Trump campaign for sure is going to appeal this to the Supreme Court. Most legal analysts think the Supreme Court will take the case. They don't have to, but there's a good chance they will. And then the Supreme Court will settle it. So the Supreme Court could basically overrule Colorado, in which case basically everything goes back to normal. But what if it does not overrule Colorado, or what if it says that this can actually stand in Colorado? Well, Colorado itself does not matter that much for President Trump. He could win the Republican nomination without Colorado, and he lost Colorado in 2022, and it's not likely he would win it again. It's not really a swing state. But what if other states were to try to do the same thing? So if the Supreme Court says, yes, we allow this, and then other states, swing states like Pennsylvania, Arizona, Nevada, who knows, that would really throw a new wrinkle into the election. So I think there could easily be some other unexpected things in this election. So get ready for a bumpy ride, everybody.
Rick, where does this rank among risks for the market?
Investors don't care that much about the election when it's 11 months away. What do investors care about right now? Clearly, they care about Federal Reserve monetary policy because we're right in the middle of that. We're right in the middle of a pivot. But guess what? That's going to change a lot when we're 6 weeks, 4 weeks away from the election. And in a close election like this is likely to be, changes in the outlook for who's likely to win absolutely move markets because there's a lot at stake here. Trump, for example, wants to impose a 10% import tax on everything that comes into the United States. I mean, that's a major business issue. There's a big question of what to do with some of the Trump tax cuts that are going to expire at the end of 2025. Do you leave those tax cuts in place for the wealthy, or do you repeal them? That has a direct impact on investing decisions. And Trump also would probably clamp off trade with China more sharply than Joe Biden or a Democrat would do at this point. And then there's, immigration policy will differ. So there could be big differences between Trump and another Republican candidate if Trump ends up not being the nominee. And then also very big differences between Trump, the Republican, and Biden, the Democrat, or whoever the Republican, the Democrat turn out to be. So the stakes are high here. And this is going to be the market's main focus once we get to October next year.
All right, the political uncertainty that continues to move forward that we're going to continue to watch over the next 12 months here. Rick, thanks so much. Appreciate it.
Bye, guys.
Well, Rick teeing up the conversation for us. For more on the Colorado Supreme Court's landmark decision, we're joined now by Richard Painter, who is the former chief White House ethics lawyer in the George W. Bush administration. Thanks so much for taking the time here this morning. Help us kind of triage this thought process or the what comes next of this out here, because this just out of Colorado kind of setting the scene for what's going to eventually get kicked into the Supreme Court, we believe, and now ultimately has some broader election implications. What would you be watching for?
Well, first of all, I should emphasize that the decision here in Minnesota, my home state, in Michigan, was not in favor of Donald Trump on the core issue here about disqualification under 14th Amendment, Section 3. The Minnesota and Michigan courts simply allowed the Republican Party to put Donald Trump on the ballot for the primary if they so chose, and then would address the disqualification issues for the general election. The Colorado Supreme Court chose a different tack, which I think is a lot fairer to the Republican Party, which is to decide the issue now. Is Donald Trump qualified to be president of the United States, or is he disqualified for insurrection under 14th Amendment, Section 3? The Colorado Supreme Court answered that question in the affirmative. This gives the Republican Party and voters in Republican primaries, which will include myself in Minnesota, where independents are allowed to vote in primaries of the two major parties, the opportunity to select a different candidate, a candidate who is not disqualified from public office, who did not participate in insurrection, whether it's Governor Nikki Haley or someone else, whose policies would very much conform with the Republican platform without the baggage that Donald Trump would bring into office with 4 criminal indictments, 91 felony counts that have to be tried either before or after the election. So this is an opportunity for the Republican Party to look at other candidates. And so we can have an election in November where there are 2 real choices in front of voters, 2 candidates who voters respect as people who are loyal to America, but have different perspectives on what we ought to do as a matter of tax policy, immigration policy, and trade policy and the like. And so hopefully that's where this is going to go. We'll see what the United States Supreme Court does. There are a number of options. They could simply let Colorado do what they will on this, saying this is a reasonable interpretation of 14th Amendment, Section 3, but not impose this decision on the other 49 states. The Supreme Court could go the other way and simply say Donald Trump is disqualified from office in all 50 states on the ballot. Or, yes, the Supreme Court could side with Donald Trump and say that he's not an insurrectionist, that he can be on the ballot in November despite his upcoming criminal trials, 2 of which are directly related to the insurrection of January 6th.
And Richard, so do you think this becomes a trend then that we see from the states? Is this a move by Colorado that then other states would follow? Where do you think things go from here in terms of that perspective?
Well, some states may choose to follow. Some states may choose the route that Minnesota and Michigan did, which is to allow Donald Trump to be on the primary ballot, but then address this again with respect to the general election. I don't think that approach is fair to the Republican Party. I think the Republican Party is entitled to have this decided now in all 50 states. I believe Donald Trump should be disqualified for the ballot. I think the Supreme Court should make that decision in early January so the Republican Party has an opportunity to move on. But we have yet to see what the Supreme Court does, and other states will have a number of options or fewer options depending on what the Supreme Court says in January.
All right, we're going to have to wrap it up there. Richard Painter, former chief White House ethics lawyer, thank you for joining us today.
Well, thank you very much for having me.
And taking a look at shares of FedEx extending losses in pre-market trading after reporting disappointing second quarter results and lowering its full year revenue guidance, now expecting single-digit year-over-year declines in revenue due to the difficult demand environment. The company's CEO, Raj Subramanian, warned back in September of 2022 that a worldwide recession was coming, and he said on the company's call on Tuesday night that this still holds true. Brad, we've got shares of FedEx down about 11% right now. Does seem like there is a little bit of an overall demand call here from FedEx saying that they think that the U.S. consumer and overall demand is slowing down. That's part of what's hurting the business here. Also, though, I think zooming in more, seems like there might just be some FedEx-specific issues here going on, and a stock that was up 60% year-to-date coming into the report, right? You see moves like that when you've had a good year.
Exactly. I mean, the read-in on FedEx is that this is a company that gives you a line in on what's taking place with the consumer, of course, at a time where everybody's tracking all of their packages to see where it's ultimately going to arrive, when it's going to arrive, especially going into amid the holiday season. So that's one read-through that you get here. You get a read-through in the holiday season. You also get a read-through on where businesses are having to incur some of the added expenses and where they're passing that through to the end consumer, because FedEx is looking at this environment and really looking at this peak season, as they define it, as where in this demand environment they can continue to pass costs on. They were talking about that a little bit on the call last night and saying that this is an environment where in the demand surcharges that they're seeing here, they're having to make sure that they can pass that through to the consumers, to the customers that are out there shopping. And so that's one additional. But then at the end of the day here too, the warning here that FedEx provides here, it, I think, gives you more inclination about how a company that is this large really gives a broader read into the markets and valuations that we've been tracking as well here. And so for some of those retail stocks, and we're going to get Nike this week as well, just ahead of the holiday season, do you get a little bit more of a read in on actively what's taking place in quarter on some of those retail players, even if they've already reported, based on what FedEx volumes are looking like?
And the other thing, Brad, that I think is important to point out here is this FedEx quote unquote warning about consumer demand shouldn't necessarily be shocking, right? We've been talking about a consumer slowdown going into 2024. Look at the retail earnings that we covered for the last month. Consumers are slowing down. You're seeing it in hard economic data like retail sales. So it's not shocking to see FedEx tell you, you know what, 2024 is going to start off a little bit slower. I get that it is not going with quite the story that we've been following with FedEx this year, but overall, I think it's not necessarily at a narrative here for FedEx to warn about the consumer coming into 24. But we've been talking a lot about headwinds. I'm going to bring in someone a little bit more optimistic. Our next guest maintains her outperform rating on the stock. Joining us now is Helene Becker, Cowen Senior Research Analyst. Helene, I want to just open broad here and just get your overall thoughts on the print from FedEx, maybe why you think the stock is trading lower right now and any positive sort of threads you're still seeing within that print.
Yeah, thanks for the question. So our view is kind of interesting, right? You mentioned we have an outperform rating on the stock. As I was listening to the conference call and their, in general, optimism about the company itself, and I was watching the stock trade down in aftermarkets trading and knew it would open down this morning. I was thinking to myself, am I listening to the right conference call? Because they were talking about how aggressively they're working to cut costs. And for them, and this is the reason for our optimism, for them, it's really about a multi-year program to get costs down, to shift away from the old narrative of operate independently but compete collectively, and rather focus on bringing operations together, get rid of facilities that are underutilized, that they don't need, restructure the entire fleet operation and the way they operate the day sort and the night sort, and use less aircraft to get the job done as shippers what is the right word, downgrade from high-priced alternatives like air to lower-priced alternatives like ground. And instead of having an express truck or van in your neighborhood and then an hour or so later have a ground van in your neighborhood, kind of combine them and lower costs that way. So our view is multi-year, which I think is important because, to your points, which are very correct in our view, is that we're going to see a really tough first half, calendar half of 24. And that obviously coincides with the second half of their fiscal year.
What's your read through to the consumer based on what we heard from FedEx last night on the call?
Yeah, well, it would seem that there's a shift going on, right? Retailers are encouraging shoppers to visit their brick and mortar stores, whether it's buy online, pick up in store, or just go to the store for deals. So we think there's that shift going on, but to your point, everything we've heard is that the consumer is spending less and slowing down. And we were expecting an okay peak season, but not a great peak season, as people have shifted to more experiences with their families rather than just buying lots of stuff that go in a cupboard after a day or three and don't get taken out again.
And so, Helene, sort of zooming out on that and thinking about what it might mean for, is this demand going to other competitors or is it just going away in period when we think about consumers and, is UPS getting part of that business or is Amazon getting part of that business in the holiday season? How are you sort of reading that? Where is the business going or is there just less business to be had?
I think there's less business to be had. I think that's part of the answer. FedEx said in response to questions that they picked up about 400,000 packages a day on average from the UPS threatened strike earlier this year. and that they've kept a big percentage of that. They feel as though they've also kept a percentage of the yellow freight capacity that they pay, or volume rather, that they've picked up. So they think they've picked up both, but and they haven't lost any. But there's always a share shift between the companies, right? UPS and FedEx tend to trade accounts. There are a lot of shippers that don't want to rely on just one provider. They like to rely on both FedEx and UPS to keep pricing honest and to keep it from getting out of control. Because remember, both these companies raise rates to shippers every January between the low end, roughly 4.5%, 5%, and at the high end, as much as 7%. So you're seeing rates go up, and that also causes people to shift demand away from next day to later in the day or 2 or 3 day delivery. So that's part of it. And there are some, as I said before, there are some shippers that will move capacity or volume between the two main providers just because whoever has the better opportunity to get the packages there faster is really where you want to go.
Helene, you had mentioned the consumer shift earlier into purchasing on experiences as well. And thinking about that, of course, this is a jolly time of year, people traveling to see family and whatnot. You know, at the end of the day, we had been getting more updates from TSA, which I believe tomorrow kicks off its official kind of holiday, well, not holiday, but their kind of peak season as they track it. They expect this holiday season to be the busiest ever. 2023 already seeing 7 of the top 10 busiest travel days in TSA's history. I believe Delta's your top pick for 2024. Where do you believe the kind of overflow or the permeation of this experiential travel mindset from consumers could prevail in 2024?
Yeah, so remember, part of what's going on is the economy is just so much bigger than it was in 2019. And so on that basis, people would travel more. And from our perspective, here's what we think is going to happen next year. We're going to see pretty good domestic recovery, in part because airlines are taking capacity out of the domestic market. We think international will continue to be strong with more of a focus on the Pacific than on the Atlantic. I think everybody, air quotes around that, went to Italy last summer. Not sure they're going to go back this summer, but we do see United and Delta, which United was our best idea for this year, and Delta, as you point out, for next. We see them restoring seasonal capacity. We don't see them adding more than the industry average in the Atlantic. In the Atlantic, we see capacity growing almost 9%. And that's what happened in the domestic market, by the way, this year. And we saw the domestic focused airlines lose money. Now, we're obviously not forecasting money that the guys will lose money in the Atlantic next summer. We think it's going to be another strong summer. We just don't think that pricing is going to match what we saw last year when, I don't know, the route that we always check, one of the routes we check, New York to London, New York to Paris. During the Paris Air Show, it was as much as $8,000 to $13,000 to fly business class between New York and Paris. And now, if you look at that, it's closer to $3,000, which seems to be more normal and more maybe agreeable. Like people will pay $3,000, but they're not going to pay $13,000.
Right. Yeah, no, I would definitely be asking to borrow your corporate card for that purchase, Helene. Certainly appreciate.
Yeah, I think the boss would reject that idea too.
Look, I don't think any of us are getting that approval to go through. Helene Becker, TD Cowen, Senior Research Analyst. Always great to speak with you. Happy holidays, Helene.
You too, thanks.
Thanks. We're watching shares of Alibaba today after announcing further changes. The company's CEO, Eddie Wu, will now head to its e-commerce business as it seeks to find growth drivers amid increased competition from rivals like Pinduoduo. You're taking a look at shares up by about 0.1% here this morning.
Yeah, and you saw Alibaba actually close up about 2% yesterday, right? Really taking a little bit of a move higher on this, and I think that's when you zoom out and you look at Alibaba shares over the year. The year-to-date stock down about 20%. And really sort of looking for some kind of new catalyst. You mentioned Pinduoduo, Brad. That's a company that's been growing sales, right? And growing online sales significantly. Essentially, people feel like maybe taking market share from Alibaba. And then we're mentioning Pinduoduo, who's public. You could also mention companies that aren't public, right? Think about Shein over in Asia, growing tremendously. Obviously, a company that might be coming to market soon. Even Temu, a pretty big retail company, also growing. And so I think you're just seeing perhaps investors maybe a little bit happy to see the company saying, okay, something needs to change here. Let's put someone different in charge, see if we can spark something different. And also going to be in charge of that cloud unit, which includes AI, and we know.
Yeah.
You got to do something in AI.
Well, 100%. You got a call out from Jefferies this morning, which has a buy rating on the stock that said Baba announcing Group CEO Eddie Wu to take charge as CEO of TTG, expecting the leadership from Eddie to further unlock synergies and drive AI innovations. That was basically half of the headline that they put on the note as well. So at the end of the day, you got some bullish sentiments that is prevailing here, at least as of right now, for Alibaba from some of the analysts covering the name.
Absolutely. All right, we got to keep it moving here, though. Let's take a look at shares of General Mills falling in pre-market. The packaged foods giant cut its full-year guidance after softening demand from consumers in its most recent quarter. Madison Mills is here with more. Madison, give us the skinny on the report. What's up?
Well, good news is bad news for General Mills today, and we're seeing that come up in the data. They've got the double whammy here of consumer spending softening while we're seeing food disinflation. So this is the definition of a firm that no longer is going to have that pricing power. And we've been hearing from other retailers for some time now. I did a story, I think, 6 months ago about how Walmart was tired of the high prices coming from General Mills. That allowed some competitors to take up some market share, and what that looks like to the consumer is some space on the shelves, and you're seeing that impact both their volume and their sales today. I spoke with Third Bridge analyst John O about this name this morning, and he said the same thing. Experts indicating that there's likely no more room for this name to push pricing. They've got continued pushback, increasing pressure from retailers like Walmart that I mentioned. Also concern that they've taken on too much pricing in certain categories of consumer spending. We saw that pet sales in particular were a huge ding for General Mills in their sales here. But what's really interesting is this name is going to potentially be a leading indicator for earnings coming up starting on January 12th. Mark your calendars, guys. This could be an indication of what we're going to see for a lot of these consumer packaged goods brands heading into 2024, and whether or not, consumer softening, that food disinflation is going to be a negative picture for a lot of these names.
Yeah. I mean, if they raise prices anymore, I would need to use that Affirm option at Walmart in order to pay for it.
Tie it all together, Brad.
Yeah, finance the cyclical purchase of my cereal every week.
Cheerios. There you go.
Exactly. I mean, look, some of the figures that they tossed out here, I mean, it's really telling about where the consumer is starting to push back. And specifically, we've started to see this already play out in previous quarters on the volumes that are actually being sold as well here. I mean, net sales, they were also down, though, in this case, 2% in the second quarter. And so that's something for investors to grapple with, perhaps why shares are moving lower, one of the reasons as to why they're
I just think something that Maddie highlighted that we've been waiting for is just inflation to come through in these earnings. And this, we're talking a lot about inflation falling, and you're wondering, okay, so who does that actually hurt? And we've been waiting, as you said, 6 months ago, right? We were talking about this, sort of waiting for it to come through more in earnings.
Yeah.
And it seems like this is maybe the start of that trend. So inflation coming down, good for all of us, but not always good for every company that benefited from it when it was on its way up.
Right. Hopefully good for prices on the shelves, though,
Yes,
for us.
exactly.
Guys.
Good for consumers.
Yeah,
I'm happy
good
to
for
pay
us,
less.
yeah.
I'm happy to pay less.
Maddie, thanks so much for breaking this one down. We'll have a little bit more from you later on in the show. Appreciate it. Well, stick around. Just a few minutes left until the opening bell on Wall Street, just about 6 to be exact. You're watching Yahoo Finance.
Let's get you to today's market commentary. Atlanta Fed President Raphael Bostic giving his take on how the central bank should handle rate cuts in 2024. He doesn't see strong signs of urgency to lower interest rates next year. Now, Morgan Stanley seems to be on the same page. The investment bank saying in a new note that market expectations for a rate cut in March are overdone and expects the first rate cut to play out in June. Brad, this, of course, all coming with the context. We've got markets pricing in about an 80% chance for a rate cut in March right now. That's, of course, been the big narrative here. That's what's gave us our stock market rally. That's what's brought small cap soaring, everything like that. And really, the more Fed commentary we get, the more it seems to be, okay, let's slow our roll here. We still need to see inflation come down a little bit more before we get cuts in March. Of course, in some ways, that's really just the central bank's role here, just to say, hey, let's not let the market get ahead of ourselves and ease conditions too much, right?
Yeah, we've been trying to kind of characterize each of the dots on the dot plot, and I think as days go on this week, we're getting just a little bit more inclination or getting a little bit more clarity around who might be which dot from the conversation that our own Jennifer Schonberger had yesterday with the Richmond Fed President, Tom Barkin, or if what you're hearing from Raphael Bostic here. And I mean, it's right to look out into, I think, the second half of next year, as many of the guests that we've been speaking with have been discussing and pointing us to, because the larger question is what would happen between now and then that is so dire in the economy that the Fed is seeing in order to initiate a pattern of rate cuts or even consecutive rate cuts, as some economists have talked about.
Right, and that gets to the point, too, of understanding what kind of cuts you want, right? A lot of strategists and economists talking about this. You get a cut in March. A lot of people that have that plotted out also see unemployment going up to over 4%, maybe 4.5%. We're talking recession for some people if we get a cut in March. And that's not obviously an ideal scenario for us here. I do like your idea, though. We got to get a meme of the different Fed officials on the dot plot.
I mean, I would love to see that. If they give us, we just need to kind of figure out the rest of the dots here. But at least we've got some inclination of where Bostic and Barkin might be. Bostic, though, for his comments, saying this economy is far stronger than I would have imagined it would be 12 months ago, and I'm really grateful for that. And you mentioned unemployment rate remaining below 4%. It has to this point throughout their policy pathway. It's a larger question of at what point do we see that? And this was a surprise this most recent month, we should also note, because we clocked in at 3.7%. We were expecting that to stay at what, 3.9?
3.9%, yeah. So to see that come down, big.
We're taking a look at the opening bell, both on the New York Stock Exchange and at the NASDAQ here. You got a kind of solo duo opening bell taking place there in Times Square. But then in the NYSE, you've got Womankind ringing the opening bell there. All right, so great look at some funfetti, great look at some representation up there on the podium at the New York Stock Exchange as well here. Let's take a quick look at the markets as well as we kick off today's trading session. The Dow, the S&P 500, you're seeing those negative. That NASDAQ is going to be calibrating for us. We'll get a quick look at that, and there we go. We're down across the board for the Dow, down by about 0.2%, about the same case for the S&P 500 and the NASDAQ on a percentage basis. Let's get to Madison Mills in the Yahoo Finance newsroom with some of the biggest themes moving markets this morning. Hey, Maddie.
Hey guys, so thanks for having me again this morning. I'm going to start off on existing home sales. We're going to get those numbers coming in at 10 a.m. It's going to be interesting to watch this morning, particularly because we saw the home builders numbers coming in with a surprise to the upside. So I'm curious to see whether or not we see that read through over to existing home sales this morning. Again, we're at the lowest volumes of home sales since 2010. So is that ding down that we've seen in mortgage rates, just a touch down to the 7 handle there, going to impact home sales this early on following that shift in that rate? So we're going to get some more insight into that coming up at 10 a.m. here. I also want to talk a little bit about the FOMO trade. Ed Yardeni coming out with a note saying that some of the cash that's been sitting on the sidelines, it's going to have to get in on some of the trade here heading into the end of the year as we start to see more of a push for some profits to be proven out for the year of 2023 here. So interesting, though, to see that when you look at fund manager surveys from Bank of America, they're showing cash levels still at 2-year lows. So where's that cash going to go? Well, potentially it's going to go into the bond market because at 1 p.m. we've got the Treasury selling $13 billion worth of 20-year notes. Whether or not that money gets flown into the bond market is going to be interesting because remember, guys, we're not that far off from that 5% return on those bonds. We're now down to about 4%, but sometimes the market sees that decrease as a positive because 5% seemed like it was a little bit too high. Now they want to get in before it goes all the way down to 3%. So definitely a FOMO trade hitting the bond market as well. It's not just all about equities. And guys, more broadly here, I want to talk about the geopolitical risks heading into 2024. Obviously, overnight, we saw what happened with former President Trump's campaign out in Colorado. The market not really seeing a trade there, but there's always volatility when it comes to a presidential election year, even though that on average we see about an 89% positive return on the S&P in election years. So that is good news for markets. What's definitely bad news is the geopolitical risk that we're seeing out of China. We have news this morning that President Xi told President Biden that he will reunify China with Taiwan. He hopes to do so peacefully, but that is going to be very difficult to pull off. And another geopolitical risk heading into this next year when you already have Russia, Ukraine, you already have conflict in the Middle East. And guys, this could be a huge negative for those big tech names, particularly in the chip sector, if we do see a little bit more tension in Taiwan, in China this coming year. So that is definitely going to be critical to watch for those magnificent 7 names that have really been holding up this market.
Maddie Mills, giving us a lot to watch today. Thank you very much. And now I want to take a look at some of the biggest movers at the opening bell. Jared Blickery standing by. Jared, what do you got for us?
I got to tell you, Josh, some of the biggest and most important moves are out of stocks today, but let's begin with stocks. We can see everything down here. Russell 2000, small caps leading the way down about 0.25%, so nothing big on that front. Also seeing the 10-year T-note yield down to the lowest in 6 months, and that's important. Good, I guess, recollection that we do have a 1 p.m. auction today, and those 1 p.m. auctions have been moving the market. For whatever reason, little hiccups in the bond market, they translate into hiccups in the stock market as well, and it can go both ways, up and down. Now, energy is in the forefront here. That's the leading sector. It's up 0.2%, followed by communication services and real estate. Industrials, the biggest loser, down 0.6%, followed by financials, staples, utilities, and then healthcare. But I want to focus on energy for a second because this is a trade that closely tracks crude oil, and we see crude oil jumping a little bit today. You can see it's number 1 in our heat map up here. It's up about 2%, and this has to do with some of the travel routes in the Middle East, supply lines for crude oil being potentially disrupted by some Houthi rebels that are being funded in Yemen by Iran. So geopolitics, really the name of the day here. Now here's WTI. We can see it's up 5% over the 5 days. Let me show you a year-to-date chart because this is a really sideways, choppy chart for the most part. This big spike up here, that had to do with the Gaza incursion, the Gaza war, and now we came right back down, testing these lows, not exactly, but we did come down in the area. And if we are breaking to the upside here, I would just note that a lot of the rally that we saw in November that began during that time period, that was on the back of cheaper oil, and there's also the pass-through to the bond market in terms of break-evens. Not going to get into all that wonky stuff, but if crude oil is on the rise, that's going to play a much bigger part in the markets than we've been seeing lately. Finally, want to end on crypto here because Bitcoin, you can see, is up 3.4% over the last 24 hours, and we had a little bit of a consolidation here, and we are just screaming to the upside. So Bitcoin really looking like it wants to retain that bullish flavor, and I wouldn't be surprised if we take out these highs here in short order.
Something to watch there, Jared. Appreciate the update. And we've been taking a look at a slew of economic data to end 2023, from a jobs report that showed a still robust labor market, cooling inflation prints, and a more dovish Fed. Stocks have been reacting well this month thanks to all this news, keeping investor spirits alive. But there's still a lot of uncertainty on the horizon as we head into 2024. Let's bring in Matt Stuckey, Senior Portfolio Strategist at Northwestern Mutual Wealth Management, to weigh in. Matt, a lot of people sitting in this soft landing camp at this point based on all of the data we're getting. based on Fed commentary. It doesn't seem like you're quite ready to jump right into that soft landing scenario. Where do you sit at this point, and how do you see things playing out to start 24 here?
Yeah, really good points. Look, a couple of months ago, we would say that our call for a mild recession was kind of quasi-consensus, but over the last 2 months, it's kind of moved into the contrarian camp. We haven't changed our view that the ultimate result of one of the fastest tightening cycles in the last 40 years is going to be some mild form of a recession in 2024. A couple of things that we've been watching pretty closely. Even though the Fed is getting more comfortable with inflation rapidly coming down, we do think that it's going to be a challenge for inflation to firmly get down to their 2% goal. And so a lot of these cuts that are priced into the market here for 2024, we think it's likely to be somewhat of a disappointment as we move into the front half of this year if labor doesn't crack and we don't get the room for the Fed to cut in the front half of next year.
How many cuts are you pricing in? How many cuts are you anticipating that the Fed is going to need to move forward with next year?
Well, we do think the Fed will cut. However, we do think it's mostly going to be as a result of a deterioration in the labor markets that's coincident with a recession. And typically when the Fed cuts, they don't cut 25 basis points at a time. They tend to cut in response to economic weakness. And so it wouldn't be surprising for us to see something chunkier than what the market is pricing in, albeit for a response to economic weakness versus an insurance cut to kind of modulate the real rate of interest that's out there in the economy. So we don't have a specific number for you, but we do think it's likely to be a higher number, likely than the market's pricing in, but for reasons kind of surrounding recession versus trying to modulate a soft landing.
Matt, we're talking about rate cuts here, and one of the things that's been moving significantly over the last month has been small caps, right, in the Russell 2000 as sort of that anticipation of rate cuts has come. Great chart out from Bespoke Invest showing that the Russell 2000 went from a 52-week low to a 52-week high in just 48 days, kind of a massive move for the Russell 2000 there. Curious what you make of that move. Is the Russell 2000 still at a good valuation here, or has that move been too aggressive and we're sort of already getting ahead of ourselves from a pricing standpoint here?
Yeah, it's a good observation. And it's been a good story for investors that have been diversified in their portfolios across fixed income, equities, and real assets. Small caps specifically in our portfolios have been overweight, coupled with a defensive overweight to fixed income. And the reason why we liked the small cap trade is because we saw a lot of the weakness in small caps kind of pricing in a macroeconomic outcome of recession. And what I mean by that is you look at the earnings estimates for 2024 in U.S. small caps, those have already been marked down by 15% or so. And against those reduced estimates at the time prior to this big rally from the back half of October till now, we were only paying 12, 13 times earnings for those reduced estimates. And so to us, coupled with, overweight to core fixed income, we kind of liked that risk reward where we could be defensive in our fixed income positioning, but also, in case, this economic cycle were to prolong into 2024 longer than we expect on the expansion side, we could get a pretty quick catch-up trade in the small cap side, and that's kind of what's happened here in the last few months.
Is the Russell 2000 still the best small cap trade? Because from what we've also heard, it might be best to look at indexes that have a profitability filter even.
Yeah, that's a really good point. We prefer looking at the small cap 600 versus the Russell 2000, specifically because profitability is more emphasized in that index relative to the Russell 2000, where there's a greater percentage of firms that are unprofitable. And that's not abnormal for smaller companies that are growing quickly to scale. But, with our assessment that we're later in an economic cycle, we think overweighting factors like profitability makes a lot of sense.
Matt Stuckey, who is the senior portfolio strategist over at Northwestern Mutual Wealth Management. Matt, great to speak with you here this morning. Thanks. Short sellers losing big on Affirm this year after shares of the buy now, pay later company rebounded. Traders lost about $1.5 billion on the stock as it surged over 400% in 2023. Affirm is not the only company that crushed short sellers this year. Carvana shares also rose this year, costing these traders about $2.2 billion here. And there you're taking a look at some of that year-to-date activity. You've been tracking this alongside S3 Partners, who's been able to pass some data through.
Yeah, Brad. I mean, these stats always just stick out to me when you think about. I was thinking about yesterday's market action, right? Yep. And our head of news, Miles Upland, wrote this in our blog online, but sort of pointing out, the Affirm stock move of about 15% yesterday on a deal with Walmart is perhaps less about the deal with Walmart and more about where the market's positioned in terms of Affirm. I mean, you look at the stock up 100% over the last month. Now, we should mention significantly off the highs that we saw in 2021 after a tough 2022. But a lot of this comes down to the short selling that you see in a stock like Affirm. S3 Partners also pointing out a stock like Palantir, a stock like Pinduoduo, Carvana, some of the stocks that when you and I take a look at the market every day and we're like, why is Carvana up 20% today?
Right.
There's no news. There's not a ton of news going on here. Sometimes it's just those shorts getting squeezed because the market is so heavily betting against a company like Affirm, a company like Carvana.
Right, and it's a larger question of when a lot of that short selling and that betting against these companies also initiated. Because if you're looking at, say, the midpoint of this year or any time between mid-September through the beginning of November, a lot of that shorting perhaps would have been beneficial for them if they were in the market at that time or in the money at that time. But at the same time, you look at the covering that they've had to do since then. I mean, November was really the initiation, beginning of November was the initiation of that rally in shares of companies like Carvana, like Affirm as well, that since that point in time have been able to see their shares actually take back much of those, if not all of those losses that they had seen.
And a final point I'll make on this too, when you mentioned when were these shorts put in, some of the biggest losers this year, people that bet against these stocks, short sellers lost a ton of money. Tesla, Nvidia, Apple, Meta, Microsoft, Amazon.
Yeah.
The Magnificent Seven are or Magnificent Six, I guess we can go with here, are the top six, right? So that tells you how the market was feeling about big tech after that tough 2022 coming into 23. A lot of people thinking those stocks would go down, and that is not what happened. So it led to a total of, I got to get our grand total number here, Brad, because it's huge. Yeah. $177 billion lost by short sellers thus far this year. Wow. And the year is not over. But
still got days left.
We've still got days left to lose money. We got days left to make money, right? But we got to move on to another stock we're taking a look at. Who doesn't love the smell of fresh cut grass?
Love it.
Love it. Toro shareholders really do this morning too, Brad. The Minneapolis-based lawnmower maker reporting full year results today, raised its EPS guidance and beating the street's expectations. The CEO attributing its success this quarter to its innovative products and strength in underground and specialty construction. The outdoor maintenance company raked in $4.5 billion in 2023. That's up from $4.51 billion in the fiscal year 2022. So Brad, a lot of questions about the consumer right now, but one thing the consumer will not stop doing, mowing the lawn.
Well, to a certain extent here. I mean, yeah, you're not going to stop mowing your lawn, but the replenishment rate on a lawn mower is very low.
Yes.
So at the end of the day, that is one of the things that they had to say, that the strength in specialty construction, golf, hey, we love to hear that, and grounds businesses offset the sharp year-over-year reduction in homeowner demand at the end of the day and acceleration of channel destocking for residential and professional segment lawn care solutions. So it wasn't necessarily that you're going home visiting your parents and you're saying, Mom, Dad, we got to get a new lawnmower because I would love to ride around and make sure that I've got
I would.
A pristine,
I would. You would too.
Puttable green in the backyard. It's more so some of the larger businesses that are actually in the business of maintaining their greens, perhaps rotating in some of the newer options that are out there as well.
Okay.
Yeah.
Yeah. You want the putting green though.
I mean,
I would like the putting green. It's just not exactly what's happening.
I cannot wait to buy a home so I can put a putting green in the front yard. I know, debatable and highly controversial, but in the front yard. That's where it's going. Paramount shares, we're also tracking that here this morning. They are climbing higher today after Wells Fargo upgraded the stock to equal weight from underweight, citing a further M&A possibility to come in 2024. The firm also upped its price target from $15 to $18. I mean, this is the M&A chatter that will not end, especially when you got Sherry Redstone in the mix at the end of the day.
Yeah, I mean, it's interesting to see the M&A thing, or the M&A concept highlighted Within this note, of course, when you think about Paramount, that is something that a lot of people are talking about right now, and who would be the buyer, where would some of the assets go. I think Paramount is one of the companies to me that is just interesting, Brad, when I think about the diversity of product they've been able to bring to streaming and what a buyer gets, right? You're talking about a streamer that has everything from the NFL to Nickelodeon and is able to offer both of those on a streaming service. We talk a lot about the mix of streamers and what sort of sports they offer, what movies they're offering, what's the original content. And that pitch from Paramount is strong to me. I mean, you're talking about a company that hosts the Super Bowl, right? That's the largest live sporting event in the country, really in the world. So to be able to get access to some of those points, I think is something that is attractive in terms of streaming M&A that some of the other companies that we talk about, like maybe a Comcast or some of Comcast assets, NBC, it's a little bit different when you talk about Paramount. And I think they have a little bit better foothold on something like sports.
Yeah, the focus is going to be on the amount of paying subscribers that they have, but as well, it's going to be on the amount of advertisers that continue to come in. And that was one of the weak spots in the most recent earnings report here, too. So it's a larger question of if there was an M&A opportunity that presented itself that swiftly came forward, perhaps maybe to end out this year or maybe early next year, what would that combination look like in further shoring up what the subscriber base and the overall demographic of those subscribers looks like across content at a time where for much of the production houses, they're just reinitiating a lot of those production starts as well, just to get into next year and make sure that they have a strong content slate in order to go back to those potential subscribers and say, hey, look at our lineup, and here's what you're buying into next year, and the same selling point for advertisers at the end of the day.
And at the same point, we're talking about streaming prices rising, right? And not everyone is going to want every single streamer anymore as they get more expensive. So that content library you're talking about feels like it's becoming more and more important.
Absolutely. All right, everyone, we've got all your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. The oil industry is on pace to end the year in negative territory despite the recent gains we've seen in oil prices on an improved macro environment and an escalation in the Red Sea. The supply and demand mismatch that shaped the first half of 2023 has inverted. Oil prices down 2.5% this year now. So what can we expect from the oil industry in the new year? For more on oil markets, we're joined by Rebecca Babin, U.S. Senior Energy Trader for CIBC Private Wealth as part of Yahoo Finance's 2024 Investor Guide. What is going to be, from your perspective, the major catalyst for oil in 2024, Rebecca?
So I think the key for 2024 is going to be, what does U.S. supply do? We saw this year in 2023, the big surprise outside of the geopolitical events that are taking place right now was the production in the U.S. massively outperforming expectations. U.S. performed by 600,000 barrels over what analysts had been expecting. Looking at 2024, the market looks very well balanced, with 1.2 to 1.5 million barrels of demand growth projected, while at the same time, 1.2 to 1.4 million barrels of non-OPEC supply projected. Now, if the U.S. continues to drag out these productivity gains and efficiency gains and continues to outperform, the market will be oversupplied. So I think the key that people are looking at is, can the U.S. continue to outperform? Does Iran, which has been ramping production, and as the U.S. has kind of turned a blind eye to some of their sanctions, continue to ramp? And importantly, what happens in China on the demand side? So those are the keys. And I think the other thing I would highlight is that expectations for 2024 are very modest. Most analysts say, I see Brent between 80 and 90. I don't see anything extreme. And I think that setup actually gives us some leadway to the upside if things start to perform better, if demand comes in better and U.S. supply is somewhat contained. So I think the negative sentiment is a little bit of a tailwind to a market that's very fearful about oversupply, particularly from the United States.
So, Rebecca, where's that leave your base case as far as maybe a price range goes overall, or just where you see things sitting? Because it seems like you feel like you're maybe a little bit more optimistic than the overall market here.
Yeah, so I think in the scenario where we have continued kind of geopolitical risk as a backdrop, a more dovish Fed, and avoiding a major recession, I kind of think we will see Brent in that 85 to 90 range, which is where I think the market's very comfortable. I'm a little bit above, I think, the street, because again, I think the estimates and the fear out there is that we get this massive supply growth again, and I'm not sure we really see that. And expectations for demand are fairly moderate. China really does have some room for demand growth next year, particularly in jet fuel. That has not fully recovered as road demand has this year, and that's really the tailwind. So I will be watching that high frequency data out of China very closely, as well as what's happening with demand in India, and keeping my eye on U.S. supply. I think those are my three kind of checklists of what I'll be watching most closely.
Yeah, certainly. I mean, that caught our attention in the newsroom this morning. What to watch, Gate of Tears, particularly as you had written it, I believe, within that summary here. You know, as we think about where investors might see other kind of secondary or even tertiary impacts from the oil market spilling over elsewhere, where are some of those kind of larger exposures that you would anticipate as well?
So obviously, I mean, crude is a huge barometer for an inflationary environment. And I think you noted in a segment prior to this that falling crude prices have really given the disinflationary story some room to run. So if we start to see this reinflation and concerns about inflation through the crude market, we could start to see people talk about how that will crimp demand. I don't think we're near a price point where that starts to happen, but that will be part of the conversation. As it relates to the geopolitical risk, I think one thing where we should be very careful and be watching is on European products, particularly their jet fuel supplies. A lot of that comes through the Red Sea. They don't have a lot of, alternate replacements because Europe can no longer access Russian products due to sanctions. And that economy is already really struggling to come out of its kind of recessionary or very, very contraction environment. So if we see fuel costs in Europe really stay high due to these geopolitical events, that's something to watch, and I think where we could see a significant impact from these events.
Absolutely. Well, Rebecca, we're going to have to wrap the conversation there. Rebecca Babin, U.S. Senior Energy Trader for CIBC Private Wealth. Thanks for joining us. Coming up, all your markets action ahead. Stay tuned. You're watching Yahoo Finance. TD Cowen is out with its holiday tracker and highlights some brands to keep an eye on. It names UGG, Hoka, On, Ralph Lauren, Lulu, Dick's, Yeti, and Academy Sports as standing out and seeing meaningful acceleration from October. Brad, a couple things to note here, just sort of digging into this. Yeah. All those names I listed, I'm not really that surprised, right? It's sort of it's the brand dominant names, which if you're owners of any of those stocks, it's good to see. But a brand dominant sort of apparel brands like that, right, you would expect them to outperform when it comes to Christmas time, right? Like people, you would expect people to be buying Lululemon at Christmas time for how well Lululemon normally does in terms of sales.
Yeah, a lot of people might be wondering what the research that they kind of went in and did around this was, and some of it is digital heat, as they describe it, into December and into mid-December. Ultimately, weaker Google search on a 4-week basis year over year. Vans was down 22%, Puma was down 17%, Air Jordan was down 15%, Nike, who we're going to hear from on an earnings basis, and their financial performance for the most recent quarter, that was down 5%, though they note Nike direct to consumer, that is actually up 9%. So all of these things considered, some of the traffic standouts going into December, the companies who you just mentioned, Hoka, UGG, Yeti, which, I mean, I'm keeping mine offset right now. But anyway, some of the strongest D2C comps that they're seeing as of right now. There was one chart that caught your eye as well as mine too, because of Jordans.
Jordan brand, Google search down year over year, 15%.
This is the Jordan time of year. Honestly, I mean, this is when you see some of those massive lines typically. And this is why, and Sean asks me all the time, why do I spend 3 and 4 days sometimes, not 3 and 4 days, total time spent in
We know you go to Foot Locker, you do your checks.
I do my checks. I do my, my SKU checks. Yeah. And ultimately, it gives you a little bit of sense of what consumers are, saying is hot. I'm going to pick it up. I'm going to spend into it, even though I'm looking at it at full price. Or if I'm saying, you know what, I'm not going to get this Christmas, or I'm not going to get it for someone else this Christmas.
Maybe when you think about the price of Jordans too, right? That's what makes you wonder of, okay, are people maybe trading down? Jordans, of course, we look at them all the time. You're not getting a pair of Jordans for probably under 100, 150 bucks, maybe 120 bucks, maybe over $200, depending on what kind of Jordans you're getting, right? So you're wondering, maybe people trading down, getting some running shoes for Christmas instead, something simple.
Yeah, I mean, at the end of the day, those Jordan Retros, they've amazed at how well they can do continuously for Nike here. Josh, thanks so much for joining us here this morning. Josh Schaefer here on the desk. On the other side of the break, we've got all your markets action ahead. Stay tuned. We continue. We roll on the other side here on Yahoo Finance. Welcome back, everyone. You're watching Yahoo Finance Live. I'm Brad Smith, alongside Brooke DePalma here at the top of this 10 a.m. hour. We're live in New York City. We're about 30 minutes into the start of the trading day, just a little bit over that. Let's take a look at how things are shaping up. Stocks are lower to start the day. The Dow pulling back after notching its 5th straight day of record highs on Tuesday. Investors are beginning to weigh those aggressive interest rate cut bets.
And taking a look at individual stocks, Canopy Growth shares on the move today after the cannabis company announced that it completed the divestiture of the skincare and wellness brand called This Works, selling it to Inspira Capital, a London-based investment firm. Now, the company is saying that they are focused on achieving leadership in the cannabis space.
And CRISPR Therapeutics chief medical officer stepping down after about a year in the role. PK Morrow's resignation is going to take effect at the end of January. Comes just weeks after the FDA approved CRISPR's gene therapy to treat sickle cell patients.
And today, I'm also taking a closer look at shares of Costco. The stock closed at a record high Tuesday after the bell at $677.74 per share, bringing its market cap above $300 billion for the first time. Now, this comes just days after the wholesale retailer reported positive results in its most recent quarter. And Brad, what a run it has been for Costco so far this year. We have seen shares skyrocket, and over the past 5 years, they've skyrocketed more than 200%. Really, investors taking advantage of Costco coming in as a value play here as consumers' wallets remain pinched.
Yeah, one of the calls that's out this morning as well here on Costco. North Coast actually downgraded Costco to neutral from buy. Maybe they're just taking a look at the valuation and saying, you know what, it's a Goldilocks type of scenario. You're taking a look at the consumer environment, though, on the other hand, perhaps, and saying this might be in a trade down environment, one where consumers continue to lean into the buying in bulk or the wholesale businesses that are out there as well.
Yeah, and value perception, the valuation here, a big contender for Wall Street right now. But, you know, if you take a look at where it stands against one of its main competitors being Walmart, I mean, Walmart just up roughly about 9% year to date, Costco up more than 46%. So when you sort of compare these two, both trying to get into value plays here, it really is pretty amazing how Costco's come on a top. And Costco, a big 2024 for them as a new CEO takes the helm. We know that Ron currently serves as COO and president since February 2022. He started at Price Club. He's been at Costco for more than 40 years. And so the current CEO saying that it's going to be pretty seamless for this transition.
Yeah, a lot of people would be hard-pressed to name anything that they've done for 40 years. All right. Well, ultimately, we're also tracking hype around generative AI. It allowed tech stocks to surge in 2023, dominating the rest of the market. Can we expect this to continue into 2024, or is there another trend on the horizon? Here with what's next for tech is our very own Dan Howley. Dan, what's next for tech?
I'm going to be the tech Kreskin over here, and I think just because the clock strikes midnight on January 1st doesn't mean that AI is going away. It's still going to be a huge presence in 2024. I think one of the things that some of the analysts I spoke to are expecting is a play into what's called the AI PC. So the AI PC is basically a PC or a Mac in this case, where you have chips that are specifically dedicated to running AI services locally. So the idea behind that is, okay, if I want to go through my email using some kind of AI software, or my calendar, or my notes, I can use an AI PC, and everything is going to be done on board my device rather than in the cloud. And so this way it ensures more privacy. It's going to be a little bit faster. So I think that that's something that we're going to see a lot of talk of. We're already seeing it, by the way. AMD, Intel, Qualcomm. Google is now running onboard AI, its new Gemini Nano generative AI model on the Pixel 8 Pro smartphone. So it's coming to everything. You can expect it to go to Apple as well. One of the other things, mixed reality. It's going to get its biggest test yet because Apple is going to launch the Vision Pro. That's its big AR, VR headset, spatial computer, if you're Apple, not a headset. They refuse to refer to it as that. $3,500. It's going to be expensive. It's also going to be able to do things like allow you to bring the world around you to a screeching halt and just go all VR, turn the knob, and it becomes AR. I tried it on. It blew away anything else that I had tried yet. What's the use case, though? I'm still waiting for that. I'm not completely sold. Even video games. You know, I'm a big gamer. I got a 65-inch OLED. Why do I want to strap something to my face when I got a great TV in front of me? I can get up, go to the bathroom, go to the fridge without having to rip something off my head. So we're going to see if Apple can do that. Meta so far hasn't been able to. And self-driving cars are still going to be a big deal, despite the setbacks we saw with GM and Cruise, despite the setbacks that we saw with Tesla and that 2 million vehicle recall. We're going into CES 2024. It's going to be one of the biggest themes. It's always a huge theme. I think one of the things to keep in mind, though, is a lot of this was dramatically oversold as to how fast these companies could get their vehicles to be autonomous. The one company, I went to a Ford event, a while ago, not to throw Ford under the bus or the F-150, whatever you want to say. I went to a Ford event years and years ago. They said that we would have self-driving cars very quickly. Honda was like, guys, it's not happening until like 2050, the earliest.
2050, my
so
gosh.
It's still coming. We're going to see more and more on that. But advanced driver safety and self-driving are still going to be huge trends in 2024.
Dan Halley, thanks so much for the breakdown. What to watch? I feel like AI was such a big topic in 2023. Now it goes into play in 2024.
Keep on rolling.
Keep on rolling for sure. Well, Apple halting sales of some of its watches this week. The tech giant will no longer be selling the Apple Watch Series 9 and Apple Watch Ultra 2 following a dispute with medical device maker Masimo over its blood oxygen feature. And while its stock has rallied along with the other Magnificent Seven, it hasn't been easy for them sales-wise. Our next guest thinks Apple's strength is keeping users within its ecosystem while its competitors are winning in innovation. For more on how the tech giant is shaping up into 2024, Gil Luria, D.A. Davidson Managing Director, joins us now. Good morning, Gil. Over in your note, you called this an inopportune time for this to happen to Apple, particularly with this crucial holiday week underway. How do you see this sales glitch play out into early 2024?
So the impact to Apple isn't going to be that material. They've been able to hold off. They'll only need to take it off their own shelves December 24th. They're taking it off the website today, which means it's only a very narrow demographic that's actually going to lose sales. We're talking about husbands that waited to the last minute to buy their wife a gift, that instead of buying the Ultra 2, they're going to go to the other part of the mall and buy something else. That's not a lot of sales, but this is still embarrassing. It shouldn't come to this. These cases always get settled, and somebody decided to gamble on the appeal and not settle with Masimo, and this is an embarrassment for Apple. Again, the sales loss may not be material, but it's still embarrassing. They're going to have consumers confused. They're going to go to the store. They're going to want the Ultra 2 or the Watch 9. They're not going to be able to buy it. By the way, they can buy it at Best Buy or at other retailers, but they won't be able to buy the Apple Store. You never want to frustrate your customers. That's really going to be the outcome here. And it ties to a bigger theme of innovation that you touched on, too.
Yeah, Gil, as you're thinking about that innovation, is Apple stock still sexy if they continue to have this design mental block, as you call it?
The iPhone hasn't really changed since version 12. There's only been very minor tweaks to it. That's the flagship product. They need to do more. The watch has had some advances, some cool new features in the Ultra 2, but the form factor hasn't really changed. You mentioned earlier the Vision Pro. The Vision Pro is really just a developer tool. It's not really a consumer product at $3,500. In the meantime, other companies are innovating with form factor, with folding phones, with glasses that have these augmented features, with AI pins. Apple has usually been a quick follower on these new innovative form factors, and right now it appears to be a little stuck. And for them to get revenue growth in their hardware business, they need to get unstuck on the innovation front.
Let's talk about that a little bit. Do you necessarily think that Apple needs to come out with a foldable handset like Samsung did?
Not necessarily, but they need to give us an iPhone that looks different. You can't have the 12, the 13, the 14, and the 15 iPhones look almost exactly the same, with very minor changes to the camera, to the zoom, to how the island floats. That's not enough to compel people to upgrade ahead of a phone breaking down. And unfortunately for Apple, fortunately or unfortunately for Apple, fortunately for consumers, iPhones don't really break down. they've become so rugged and so useful, even with the software upgrades that they get every year, that they need new reasons to compel people to upgrade. They can make the screen bigger, they can make it thinner, they can make it transparent. They need to do something with the form factor to accelerate an upgrade cycle.
And on that note, when you think about 2024, do you expect a strong uptick in upgrades? Or are people going to hold on to their phone saying, they don't necessarily need this right now? And could that hurt Apple sales in 2024?
I would expect that not to change from the current rate, which is not a very fast rate of upgrade. Let's not forget, they barely grew revenue on the hardware side. On the service side, they're still growing double digits. That's great. They have a lot of consumers in the ecosystem that continue to buy more and more from Apple on the services front as they get wrapped around by all the Apple product. On the hardware front, they really don't have that. It's true about the iPhone, it's true about the iPad. We talked about the watch. The Mac, the improvements are becoming increasingly incremental. So we expect them next year to have relatively low growth on all those fronts in a combined, and again, only get growth from the services business.
And so then what about on the operating side, which is largely considered to be that services business, and where Apple can push out updates that involve generative AI, as we've heard even more talk and conversation about how co-pilots are going to be evident within our smartphones that we're walking around with on a daily basis. Is generative AI enough of a sales driver and a retention mechanism to keep people in the Apple ecosystem?
Apple is very good at keeping things from us until it's ready to release them. So they may have a big advancement in how they use generative AI in their products going forward. But right now, they're a little bit behind Microsoft and Adobe in introducing some of these features. Having said that, if you'll notice, autocorrect, autocomplete are getting better and better, which is really a use of generative AI. So they are sneaking in some features quietly, but unless they have a bigger reveal of an incremental capability that we don't currently have, AI isn't going to necessarily be a big driver of their product sales.
And Gil, really quickly, a potential ban of the iPhone in China is lingering a worry among investors right now. We're seeing Huawei ramp up their competition there. How does Apple position itself in 2024 in that market?
This is one of the main reasons they need to keep being more innovative. Unless their products are superior to the products from the Chinese players, they're going to have a hard time holding on to that high end. The Chinese government is slowly peeling off levels of iPhone by taking it out of certain government agencies, other type of government entities. And so they're going to carve off pieces of the market away. For Apple to continue to be successful in China, again, they need to have products that are far more compelling than the Chinese alternatives, which are usually at a much lower price point.
All right, Gil, I'm going to put my autocorrect to the test because you said that autocorrect is improving. I've been trying to type in, all lowercase like the young kids are doing right now. It's not working for me, but I'll report back, Gil. Gil, appreciate it. Gil Luria, D.A. Davidson Managing Director.
Thank you.
Thanks. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
The S&P 500 has rallied furiously to within a hair of its all-time high, but hasn't gone too far too fast. The index is the most overbought since September 2020, and it's not just the Magnificent Seven that are fueling the rally. What does this mean for investors? Yahoo finance reporter Jared Blistering is here to break it all down for us. Jared, what are you watching?
Thank you, Brooke. I'm taking a look at the S&P 500 going back to 2019. By the way, part of my job here is to find little things that might interrupt the larger trend and cause a reversal. And with all the bullishness in the market, I'm not seeing a lot of bearish red flags here. But one of the arguments is that the markets have gone so fast to the upside here, especially stocks and small caps, which we're going to get to in a second, that at least a pause is needed, or maybe even a reversal. And that's kind of what we're seeing here. These red shaded areas here, and you can see them, like there's one as well as a hard right edge. We're in one right now. This is when relative strength in the S&P 500 is over 70. This is a measure of overbought. And in fact, it's over 80 right now. And as you said, Brooke, this is the highest reading since we got in 2020. And that did result in a little bit of a turnover, of rollover in the market. But overall, I should stress that this is something that happens in the midst of longer-term bull rallies. So maybe a little bit of a pause expected here, but not the biggest deal in the world. Now, I want to shift gears a little bit to the S&P 500 versus its cousin, which is equal weighted. So the normal S&P 500 is weighted, heavier stocks like Apple, Amazon, those get a bigger weight in the index according to their market cap. But if you look at the equal weighted, which is really the S&P 493, not the Mag 7, it's a different story. So this purple line here is the S&P 500 weighted by market cap. And as you said, too, we are within a hair of the all-time high going back to the beginning of 2020. But in the equal weight, we have just punched above these highs that we saw in July. And a relatively interesting technical picture here, because this was a 52-week low. This is a 52-week high. And the time that we got there was 33 days. And if you go back to 1957, it has only happened more quickly one time, and that was in 1982. That kicked off an entirely new bull market that lasted throughout the 1980s. So this is just another long-term bullish signal that we're seeing here. I do want to talk about the Russell 2000 and small caps. This is the Russell 2000 in purple versus the S&P 500 equal weight, and you're going to see they are matched almost tick for tick here. You can see the Russell 2000, it might stretch a little bit higher, it might stretch a little bit lower, but they have been neck and neck this year, and that's really interesting because basically large caps have just performed as well as small caps, and the deciding factor has been the Magnificent Seven and how those are rated. Of course, we don't have those in the Russell 2000. Finally, I want to close with the Russell 2000 two-year chart and show how we are now just barely punching above a level that has caused resistance 1, 2, 3 times prior. Fourth time's a charm, we're going to have to see, but I like the technicals here, short and long term.
Yeah, Yahoo finance reporter Jared Blistering. Jared, that chart that you put up on the S&P 500, that was really fascinating because if you kind of go back and look at the time correlation from where they actually, between the equal weight and then the actual valuation weighted, where they kind of unwound or detached, it was really about that time where NVIDIA held their earnings call and poured lighter fluid on this market for generative AI as well here.
You know, one final observation, I would say March is another divergence point this year, and that, of course, came with the internet bank panic, but you are absolutely right, Brad.
All right, Jared, thanks so much for breaking all that down for us. Appreciate it. Investors have been piling into the market, trying to capitalize on the recent momentum as the Dow stays hot, closing its 9th straight winning session. But questions about the Fed's next move and a risk of a recession are worrying investors. A recent study from Envestnet found that 62% of Americans are worried about their financial future, up from just 46% last year. So what does this tell us about the trends and the investment landscape for 2024? According to Envestnet, demand for advice, it's growing, and investor preferences are changing. So here to tell us more, we've got Rich Anneser, who is the Chief Strategy Officer over at Envestnet. Rich, great to have you here with us this morning. What are the broader trends that you're seeing and hearing right now from investors and where that's initiating some of the flows within this market?
Good morning, and thank you, Brad, for the opportunity. I would say there's a couple of big trends that we are observing that are really important. The biggest one from investors and investor-led is the desire for a more holistic, fulsome advice, and that advice being highly personalized. And those are two key critical areas where investors and advisors are now working more closely together to create a better advice dynamic and better outcomes for the investor. And those two things, I think, are underpinned by AI, data intelligence, as well as integrated technology that can deliver that more holistic and personalized advice.
And Rich, we really saw AI be a buzzword throughout 2023. Now, when you look at 2024, how do you think AI will go into action for financial advisors? And how do you ultimately get investors on board to trust this new technology?
So I think for the way we look at it is the way it supports a financial advisor is about making insights that help an advisor understand their book of business more clearly and what's inside it with all of their investors. So we surface millions of insights a night to a financial advisor about tax loss harvesting, about better products and solutions for an individual investor. So that's going to take a little time for everyone to get comfortable with it. But those insights are more powerful, help an advisor scale and provide better advice to their investor.
You know, it's really interesting. I mean, it feels like we've been talking about AI within advising, especially with the wave of robo-advisors that really got initiated back in 2015, 2016, around thereabouts. When you think about the performance, though, that we've seen in environments like this, how have the robo-advisors or the AI-driven advisors stacked up against someone who's got perhaps a more active investing strategy or just tapping a normal advisor?
So I think there's a couple things within that, Brad. And one component is how do they actually perform the robo advisors in an absolute performance judgment. But when you add an individual advisor with the relationship they have with their end client, you have a different outcome in terms of the performance, right? Because there's a lot of behavioral coaching that goes in. So as the markets get real volatile and they've been moving around and we see that people have concerns about their financial future, the role of the advisor is to use AI and intelligence to make smart decisions, but to also be a coach of that client to stay in the market, stay out of the market, rebalance, take an action that they're both really comfortable achieve the goals that investor wants.
Rich, this seems like a large learning curve for financial advisors to jump on. I mean, the average age, from what I understand, of a financial advisor is roughly 51 to 55 years old. How is this learning curve going? And will we see an uptick in retirement? Because financial advisors are saying this is ultimately too much for me to get on board with.
Well, so I don't think we'll see an uptick in advisors retiring because it's too much. I think you'll see an evolution in the way that advisors team and the way they partner with younger advisors with more experienced advisors is probably a key trend going on in the advisory marketplace. I think it will take some time, like we're all talking about it in any form of generative or predictive AI. As I said, we're surfacing millions upon millions of insights each night. Not every advisor is acting on them. I think what we're seeing, though, is advisors understanding them and then taking a kind of validation type of mode. They understand tax loss harvesting. They understand the need to look at different insurance products. So how do they do that in the totality, and how is the AI helping them?
And Envestnet has also been tracking across and even adding certain cryptocurrencies over the year, I believe, as well. When you think about the appetite for any investor that's looking to add this to their portfolio and really more so an appetite for risk in that manner, what are the major events that you believe will come forward next year and perhaps be a catalyst or be one of the larger drivers within crypto?
I think there's a good set of early adopters, both from a retail investor and then through the advisory channel for things like crypto. I think it's a little bit of wait and see. It hasn't been, allocated heavily into the portfolios we look through from advisors to clients. I think the regulatory environment and some of the bigger banks leaning into it, and you all would know a lot about that, I think that will have a profound impact on the allocation of things like crypto into client portfolios. I'd say the same thing is these things tend to grow. Alternatives is an area that we see more so than crypto will be more greater allocation from advisors into client portfolios.
Rich Anasar, Invest Chief Strategy Officer, thank you so much for joining us. Lots of good takeaways heading into 2024.
Great. Thank you very much.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Existing home sales for the month of November came out this morning, surprisingly edging higher by 0.8% to a seasonally adjusted annual rate of 3.82 million. Consensus thought that existing home sales would fall to 3.78 million, seasonally adjusted annual rate. Let's bring in Lawrence Yoon, National Association of Retailers chief economist, as well as Brad Case, Middleburg Community's chief economist, to talk more about what's going on in real estate. Lawrence, we'll kick things off with you. I guess, the big takeaway here is what exactly does rates need to come down to in order for more homes to go on the market come 2024?
Oh, well, the rates have come down. It was hitting 8% late October, now a little under 7%. So that will steadily bring more buyers. Now, for the closing activity, because home buying process is not a snap decision where people just switch from one day to the next, it takes time, several months, from the mindset change, from the sideline to considering mortgage application to mortgage approval, home search, contract approval. So it takes several months. So I think we will begin to see better home sales performance in a couple of months, but low mortgage rate clearly has changed some of the dynamics already.
Yeah, and when we think about ultimately, Brad, where the new home buyers are also going to be playing a role in this, according to this most recent reading, first-time home buyers were responsible for 31% of sales in November, up from 28%. And this also comes with a larger reading that we've been looking through on the inflationary picture that shows shelter costs are still the leading driver as of right now. And so all that considered, where will we eventually be seeing some of that kind of pullback? And I mean, a lot of this, because it's baked in, is going to be kind of longer run and a stickier side of inflation. So what is the expectation from the consumer side and the confidence that you'd be tracking there?
Yeah, I think the prices, the consumer inflation in house prices is likely to continue coming down for quite some time, actually. I think the thing that really is likely to hold back home buyers going forward is the concern that house prices may start to come down. It's nice to see the existing home sales up, and it's nice to see mortgage interest rates down. That's going to be helpful to people. But what's really a problem is not just how high house prices are right now, but also the possibility that they may come down over the next couple of years.
And when you think about 2024 and you think about the median home price, we did see it roughly $387,000. I guess, Lawrence, a question for you. How high will housing median home prices go in 2024? Do you think that we hit a peak already and we'll continue to see them come down?
Well, I think, the market, the house buying market has been stuck because people don't want to take on a higher mortgage interest rate, and also because they don't want to recognize that the last year or so has really been sort of bubblicious in the housing market. And if they transact, they may be in a position of looking at a lower price than they would have gotten if they had done it earlier this year. It's hard to know sort of which direction we're going to go. It's just a possibility of the downturn in house prices that I think is holding a bunch of people back.
Lawrence, wanted to give you a chance to answer that question as well, with the added thought of what is it going to take for additional existing homes to start to be listed?
What is the most unique aspect of the current housing cycle is that home sales have come down from higher mortgage rates. But even with the reduction in demand, we saw even greater reduction in supply. So simple economics of supply and demand, lack of supply is leading to record high home prices. We will hit another record high this year. The November figure was the highest for the month of November. So unless we have improvement, drastic improvement in the supply situation, we will continue to have this multiple bid process. About 1/3 of the homes in the recent transaction had multiple offers due to the lack of inventory. Now, interestingly, for the home builder side, because they are able to create inventory, they are getting more sales, which is implying that we need more supply. We need more supply in order to fully satisfy demand.
Brad, in your notes to Yahoo Finance, you made a really good point about multifamily starts increasing by roughly 15% over the last 3 months. I always find it amazing how consumers, new home buyers are looking to really, make the most of what they're buying into. Do you think we'll continue to see this trend into 2024? And what are some headwinds that are driving this multifamily home starts?
Yeah, I think, we did see a pullback in both single family and multifamily home starts, partly because of the higher interest rates that developers are facing, and also because of supply chain concerns. So it's nice to see that recovery. That really is very important for the overall macroeconomic situation. As Lauren says, we do need more supply in both the single family and the multifamily parts of the market. And so I think going forward, there will be more opportunities for people to choose whether they want to buy and to get some more affordability in that part of the market, or whether they want to rent some of the new multifamily communities, including single-family rental communities that are coming on the market. I think there will be increasing choices going forward. But in terms of the overall macroeconomic situation, the recovery in home building in both the single family and especially the multifamily parts of the market are very important for the overall macroeconomic situation.
Lawrence, just very quickly, we've only got about 15 seconds here. What do you believe that the Fed is going to be looking for most notably within the homes market and the housing market in order to finally initiate at some point next year that pivot or that shift to cutting rates?
So I think the Fed will cut rates by 4 times next year. Lower interest rate, interestingly, I think will bring more pent-up sellers to the market. Homeowners who have life-changing circumstances, I think they will begin to list property once the interest rate begins to come down. The cost of giving up their low interest rate becomes less painful.
Lawrence Yun, National Association of Realtors Chief Economist, and Brad Case, Middleburg Communities Chief Economist. Gentlemen, thanks so much for both taking the time here on the day. Appreciate it.
Thank you.
Thanks. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Labor unions had an extraordinary 2023. High-profile strikes from Detroit to Hollywood resulted in significant bargaining wins for workers. And in 2024, a new lineup of contracts are up for negotiation across airlines, Hollywood, and schools. And workers at companies like Starbucks continue to fight for a first contract. So what will 2024 mean for the labor environment? Joining us now is David Madland, Senior Fellow for the Center for American Progress. David, I'd love to sort of kick things off with Starbucks. It's been 2 years since that first store in Buffalo voted to unionize. Now Starbucks saying that it wants to finalize contracts in 2024. Do you think we'll see this happen?
There's a chance, certainly. Starbucks has changed their position seemingly because they had been alleged by the National Labor Relations Board to have violated workers' rights many, many times, hundreds of times, including by stalling and bargaining in poor faith. So this new announcement this month that Starbucks wants to conclude a contract within the next 6 months is potentially big news, because we have hundreds of Starbucks shops that have unionized, and some have been waiting over 2 years for a contract. So I think there's reason for skepticism that there's a track record of not the best behavior, but there's optimism here that the statement seems to push in a very new direction. And Starbucks, reports are that they're didn't do too well during the latest, during their latest promotions, in part because of the labor concerns from the consumers.
Yeah, I think back to some decades-long research that the Economic Policy Institute that they've been doing, ultimately, that shows that when there is a unionization effort in that industry, workers tend to benefit as well. Would that be the same case if we were to see a unionization effort at Starbucks be successful? Would the rest of the food and beverage industry really have to take note, and could we see wages increase there?
Yes, that's pretty clear that when workers in unions bargain for better contracts, other employers in similar industries tend to raise their wages. We saw that most clearly with the UAW new contract, where they had big gains of over 25%. And then the non-union auto industry from Nissan, Tesla, et cetera, all also raised their wages, not quite as much as the unionized workers, but they saw double-digit increases there. So yes, I think we could also see other retail, that there's unionizing efforts in other retail beyond Starbucks. There's Trader Joe's, there's just to name one. So I could imagine significant spillover effects if Starbucks were to get a good contract.
You mentioned the automotive industry there, so ultimately we got to go there. Tesla, do they end 2024 unscathed without having union talks?
Well, after the agreement between the UAW and the Big Three, the president of the UAW said, we're going to now organize non-union facilities, and name-checked Tesla. So I can imagine a big push by the UAW to organize Tesla and all the other non-union plants, because the big concern is the future of the auto workers is in electric vehicles. And so they really need to ensure that those future jobs are unionized. The contracts that they signed with the Big Three gave them a foothold in the electric vehicle industry, but now they really need to transition to the other competitors there. And I expect a big push in 2024 to do so.
David, I'm also keeping a close watch on the looming strike over at Anheuser-Busch. Bud Light, of course, has been a big year for them. The contract is now up on February 29th in 2024, of course. What do you think that you could take away from the Teamsters' recent agreement with UPS and look forward to this Bud Light looming contract? Any expectations that you have for this? Could we see it reach before that contract expires?
Well, the Teamsters and the UPS deal, I think, there was a threat of a strike for that, and the Teamsters were very close to striking, and then they reached a deal at the last minute with the Teamsters and UPS, and that was a big increase in wages for workers, but they also got rid of a two-tier contract and had some protections against sort of invasive technology monitoring. I could imagine a similar scenario playing out there, where there's a long record of pretty decent labor relations at both UPS and Anheuser-Busch. So while there might be concerns right now about a contract and escalating fights, there is a track record to rely on that they can fall back on and hopefully reach an agreement before there's a strike.
Yeah, certainly. I mean, look, when we think about the year that has been in 2023, how much is there still yet to be done in 2024 on the union effort, knowing it's an election year, knowing that you're going to hear a lot of different either campaign talk or in some cases rhetoric, depending upon which side is throwing shade, about unionization efforts? How much of this is still very much present for across industries right now?
Yeah, unions right now are having a big moment. And 2023 was, in some ways a kind of a record year in that the public support for unions is about as high as it's been in many, many decades. There was a big increase in strike activity. There was also a big increase in workers trying to form unions. I'd expect those trends to continue in 2024. The public sentiment, I think, will continue. In part, and also I expect a strong labor market to continue, which gives workers a little bit more power to make greater demands on their workers. And then the political support, as you noted, President Biden has said he's going to be the most pro-union president. And a lot of his actions are demonstrating that. He went out, marched on the picket line with UAW. And so I really see this as a moment for labor and workers, that the public and politicians are behind them in ways we haven't seen in quite some time.
David, you wrote a piece earlier this year about how we're going to see the rise of boards come out from different states who are looking to increase wages. And one of them I'm keeping a close eye on is that Fast Food Council in California. We know that's going to set higher wages for California fast food workers. How do you think companies should be going about this? We're hearing a lot of back and forth about how exactly they plan to adjust for these higher prices. What's your take on all this?
Yeah, well, there's several ways that companies can adjust to higher prices that they have to pay their workers. The first is that they can be more productive. They can design more efficient systems. The other kinds of things that the prices, the wage increases also lead to a boost in their consumers. So the consumers have more money to spend. So that's not just a net negative, but actually can be a positive. And the last thing is they can adjust their profits a little bit. And that's also what we see sometimes, that they're not quite as profitable. And that's perhaps why we have a lot of this kind of conflict about whether the workers are going to get their wage increases or whether the companies are going to maintain their very high profits. We're at a point right now in the economy where corporate profits are near record highs, but workers' wages were stagnant for decades and are just now starting to rise again. And so I think that's the big question is, are workers going to continue those gains in the next several years?
Where are a lot of for the unionization efforts and where they've kind of been initiated from? Is there kind of strong regional support that we're seeing in some areas versus others, or is it really just industry by industry, looking across the wages, looking across the benefits and the job retention that can be felt for years to come, perhaps?
There's a lot of ways to think about why and how unionization is spreading. One of the big things, is how companies choose to react. And I think the other interesting trend to note is that some companies are being neutral, choosing to be neutral when their workers want to form a union. The biggest one recently was Microsoft. And that's in part because they see their industry as, this is a competitive advantage in their industry to attract workers. Their tech workers want unions. And so they're saying, hey, you can do this and we're not going to fight you. So I think it's really there's a lot of factors that lead it. There's political and cultural things, but there's certainly industry trends and how employers choose to respond. And I think we can't lose track of that. Employers have a choice in how they choose to respond to their workers. And I think more companies can and might be willing to just sit down and negotiate with their workers rather than fighting them tooth and nail.
Yeah. David Madlin, who is the Senior Fellow for the Center for American Progress. David, thanks so much for taking the time here today. Appreciate it.
Thanks very much for having me.
Thanks. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
are the best and the worst airlines in the world? Well, a new survey from AirHelp took into account customer experience and airports' on-time performance this year to rank them globally. Now, Oman's international airport came in at number 1, and Indonesia's international airport, well, took the last place. I mean, what we've really seen here over the past few years, I feel like, is this ramp up of making the airport lounge area more of an experience. I mean, I recently dined in one of Wolfgang Puck's restaurants in an airport.
Oh,
In Cancun.
Casual, okay.
It was nice. It was nice. It was good food. I was shocked that we actually had a place where we could like sit down and hang out for a while. I mean, LaGuardia, we saw that recent ramp up lately.
Yes.
Yeah.
Well, I mean, every airport I feel like is changing a lot of the either infrastructure to account for the international travel demand that we have seen, and a lot of these that are on the list are international airports, we should note. A lot of the international airports are trying to make it seem like they're almost more like a mall as well, increasing that commerce that takes place if you've got travelers that have an extended layover or spending more time than they anticipated perhaps at a specific airport. But it also has to take into account what are the weather patterns of that region. I mean, where you have the most delays, where you have the most cancellations, and passengers are unfortunately perhaps going to be spending more time in those airports. That's one way to also think about this global airport ranking, as well as what, to your point, the experience for the premium traveler is like. We were speaking to Delta CEO Ed Bastian early November, and he said the demand for some of those premium experiences is higher, so they've had to really grow that out. So a lot of airlines have had to invest in these airports and their own hubs as well.
And one thing that shocked me is I feel like social media has certainly played a role into the way that you perceive an airport experience. Some travelers even going to, say, Singapore's airport to understand and see that massive waterfall. And I was shocked to see that that actually didn't make the top 10 list for the best airports. We see airports in Japan, in Brazil, as well as South Africa make the top 10, and among the worst, Indonesia, France, Bali, Portugal, among London's Gatwick Airport as well. And I think that, it really speaks volumes to, as much as the experience matters, at the end of the day, most travelers just want to get on the flight on time. They don't want their luggage to get lost, and that's what really they're looking at as well.
Absolutely. All right, we're going to continue to keep a close eye on the markets here as well as we speed to our finish, taking a look at the major averages. Dow Jones Industrial Average, the lone laggard right now, flat, but to the downside by about 0.03%. S&P 500 and the NASDAQ still in the green. Thanks so much for joining us here today, Brooke DePalma, as well as our viewers here. That's all for us today. We've got much more, though, coming up in the 11 a.m. hour. Stick around.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita with Rochelle Akufo. Here's what we're watching at this hour. A landmark decision from the Colorado Supreme Court could leave Donald Trump's name off the state's primary ballot in 2024. What this means for the big election year ahead.
And a tale of two coasts continues. We'll break down the EV infrastructure battle and why development remains so skewed.
Plus, General Mills reporting weakening demand in its latest earnings. Will the company's elevated pricing structure continue?
We'll continue to watch that. But first, let's take a look at how markets are faring an hour and a half into the trading day. Looking at a mixed picture here, the Dow ever so slightly in the flat, but still notching a record high earlier this morning, as did the S&P. The Nasdaq flirting with that territory, but not quite there yet. We see the Dow there off about 2 points. The S&P 500 there up relatively flat as well, about 0.1%. Tech-heavy Nasdaq up about 0.33% as well. Investors also mulling that results miss from FedEx, which is a bellwether on consumer demand, perhaps not as strong as expected into the holiday season. Let's also check in on the Treasury market as well. Also looking at some flatness across the board here. Looking at the 5-year, down about 0.4% on the day. The 10-year continuing its retreat from that mark of 5 that we saw earlier this year. Currently it's sitting at 3.92, and the longest term 30-year yield, the only one in the green, but ever so slightly at 4.04. Well, this week, Colorado's highest court with a landmark ruling that former President Trump's name cannot appear on a campaign ballot, saying that Trump's actions on January 6th, 2021, disqualifies him under a section of the 14th Amendment. Now, as we enter a presidential election year, the ruling will likely be in the hands of the Supreme Court. For more on what's at stake, Yahoo Finance reporters Rick Newman and Alexis Keenan are here. Now, this is a pretty complex case. So, Alexis, I'm going to have you set the scene here in terms of how this ruling out of Colorado is different from some of these other cases that we're seeing.
Yeah, so let's try to make it as easy as possible here. This is all about the 14th Amendment and one of its sections, and let's try to break it down. So what this Colorado Supreme Court said is that states cannot, under the 14th Amendment, this is in the Constitution, cannot deprive any person of life, liberty, or property without due process of law. So life, liberty, and property, you can argue Trump and his right to run as a candidate for President of the United States, and due process of law. That's a trial with evidence, with all cards on the table showing what is and what isn't in a body of court. Section 3, though, part of the 14th Amendment, that says that a person cannot hold office, public office, if they engaged in insurrection or rebellion against the United States. Now, this 4-3 decision that the Colorado Supreme Court came to, they recognize that this is uncharted territory, that these are legal questions of first impression, but ultimately saying that this Section 3 of the 14th Amendment does apply to Trump and disqualifies him from the state's primary ballot because, they say, at trial in the district court here, they say evidence showed that Trump did engage in insurrection. Now, one could debate that fact and say, well, Trump has not been convicted of any crime of insurrection, but the court also paused the ruling here, saying that they would wait until January 4th. That's a day before the Secretary of State in Colorado has to certify who is going to be on that primary ballot. But they said that that date would then extend out if, that's a big if, this case is taken up by the Supreme Court. So that is what we are waiting to learn at this juncture.
Rick, of course, we're talking about this because the former president is the overwhelming favorite within the Republican Party. When you look at the presidential election next year, this is just Colorado, but we're just several weeks out from the Iowa caucus. How do you think this shakes things up politically?
My guess is that this will actually make Trump a little more popular within the Republican Party because every time there's some new criminal charge against him, you know, he comes out and he says, look, they're persecuting me. I'm a victim of the deep state. And that actually works with some Republican voters. So, I mean, this is we have more wild cards in the 2024 election than in any other election in memory. And I think a lot of people have been so focused on Trump's criminal cases, 4 criminal cases involving 91 charges, that's where all the attention has been. And then the Colorado Supreme Court kind of surprises everybody with this ruling. So I think the most likely outcome at this point is that the Supreme Court does take the case and that they overrule Colorado, and Trump is allowed to stay on the ballot and this goes away. But that is far from certain. And there could be an outcome here that sort of lets this Colorado Supreme Court finding stand and then raises the question of whether other states can do the same thing and pull him off the ballot, which could interfere with Trump's ability to lock up the Republican primary election. And then if this happens in swing states where Trump would need to win to actually win in November 24, it could impair his ability in the general election. So if it remains an open case, it's a real can of worms, which is one reason why the Supreme Court might rule decisively on this. But boy, interesting, and we're not going to know for a little while at least.
Alexis, let's pick up on that point. What is the likelihood that the U.S. Supreme Court says, yeah, we'll hear the case, and wades right into what was sure to be a political discussion?
Yeah, so now if someone petitions, and we're expecting there will be a petition from one or both or several parties to this case, if they do, they're going to have to make a quick decision at that with this January deadline looming. But Akiko, there are some different rulings, including from the district court in Colorado. So the Supreme Court in Colorado came to a different conclusion in part than this court did. It has a different effect. And that's because the Colorado District Court, they said that this Section 3 does not apply to the President of the United States. So that's the question that the court would be taking up. Not to mention there are cases that have gone to the High Court in Minnesota. There are also cases on this issue in Michigan, Missouri. And in Minnesota, the Supreme Court there held that a primary election is more akin to an internal party election. And therefore, because it doesn't automatically place the candidate on the general election ballot, that they didn't even get into or wade into this 14th Amendment and Section 3 argument. So there are a lot of different legal avenues that the Supreme Court would be contending with here. And it's anybody's guess what they would decide about this now controversial issue.
And Rick, we know that markets tend to see a lot of volatility already in an election year. What does this mean, you think, going forward then with this new wrinkle? As we mentioned, that deadline coming up towards January 5th, and still a lot of uncertainty then going into upcoming primaries.
I think it's hard for investors to bet on the outcome of the presidential election 11 months ahead of time. And I think it's hard to bet on the outcome even before you know who the candidates will officially be, which happens over the summer, 3 months or so before the election. However, when we get to next fall, this is going to be front and center for markets. Markets really do care who wins a presidential election. And one famous example of this is when Trump had the surprise win in 2016 on election night in November of 2016, when the famous, the notorious, I guess I could say, New York Times needle started to flip away from Hillary Clinton over to Donald Trump. The S&P futures shot up because if Trump were to get elected, that means possible tax cuts, possible deregulation, and things that would basically boost corporations' bottom lines, which actually happened. And even before Election Day, there were things that moved the markets a little bit one way or the other based on whether one candidate looked like he or she was inching ahead and so on. So this is going to be a big deal for markets come, let's say, September and October of next year. For now, it just needs to play out, and everybody's obviously waiting to find out who are the candidates going to be in the first place and who's likely to have the edge.
And we are, as we said, just weeks away from primary season kicking off there. Rick Newman and Alexis Keenan, as always, thanks so much for breaking that down for us today.
Bye, guys.
Well, stocks a little mixed this morning with the Nasdaq and S&P looking to continue momentum after posting 10 straight days of gains. The rally sparked by expectations that the Fed will cut interest rates next year, but our next guest says those very expectations pose one of the biggest threats heading into 2024. For more on this, let's bring in Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Jeffrey, good to talk to you today. What's wrong with great expectations going into 2024?
Well, I guess the problem is there's so much priced in, right? We're looking at 6 rate cuts from the Fed, 6 rate cuts from the ECB, and now even maybe 6 rate cuts from the Bank of England. That's a high hurdle. It's helped to drive the stock market up 16% since late October, but it's pricing in a lot of optimism. I'm a little concerned that inflation won't prove as passive as many of these the markets and maybe even some of the central bankers are thinking. inflation has historically come in waves. We could see that in the 70s. We could see it in the 80s, even in the early 90s when inflation picked up to 5% in countries like the US, the UK, Canada, and Australia. We saw subsequent waves, meaning that inflation goes up, comes back down again. You can see on this chart, the blue line there, the history in the 1970s. The purple line is this experience here for the US, but it's not just the US that looks this way. Most countries, when they see a big wave of inflation, they get a subsequent wave. Now, I don't believe we're headed to new higher levels of inflation, but I think there are a number of reasons why it could prove volatile in the year ahead. First of all, we've got potential supply chain problems, both in the Panama Canal and in the Red Sea. We've got energy issues that may crop up next year. We've got a number of different challenges, I think, in housing and a few other areas that could create some volatility to inflation that would keep central banks from cutting on the aggressive path the market has already priced in.
And Jeffrey, when we look at how investors are looking at these rate cuts coming up next year, is it a case of the risk being more that the markets are getting ahead of themselves, or really underestimating the risk of why the Fed might be cutting if it's related to perhaps weaker economic activity?
Yeah, well, you're right. It could be a little bit of both. I think we will see some weaker economic activity in services. Taylor Swift saved the economy in 2023, but it'll be hard for her to do that again in 2024, simply because all of the entertainment and travel spending that we've seen boom in the U.S. and, Time Magazine's Person of the Year was certainly the U.S.'s most valuable person of the year as well. But as we look to even beyond the U.S., in Japan, they saw the biggest tourism money coming into the country, most tourist receipts in terms of income they've ever seen in that country. So it was a big boom in travel and entertainment spending. That is on a path to slow in 2024, even as maybe manufacturing begins to stabilize. So your point is a good one. The economic outlook for the rest of the world is a pretty soft one next year, along with earnings growth. We continue to see earnings being revised down here for the fourth quarter. And that all comes together to a market that's really been pricing in maybe a Goldilocks outcome of still relatively robust economic growth and aggressive rate cuts.
Jeffrey, you mentioned Japan there. We should remind viewers, this is the one major central bank that still has negative interest rates in place. You heard the BOJ governor yesterday sort of quiet any expectation of a policy pivot, but it sounds like you think that could be a little different going into next year. What's the risk if we see a tiny hike, maybe back in positive territory here with rates coming out of Japan?
Yeah, it wouldn't take much, right? It'd be the first one, though, in 17 years. And that could offset some of the excitement over other major central banks cutting. First of all, Japan has been a major source of investment funding to the rest of the world. Japanese investors hold over $3 trillion of investments net outside of Japan, meaning they've invested $3 trillion more outside than foreigners have invested in Japan. That includes more than $1 trillion in U.S. treasuries. Any rate hike over the next year could prompt Japanese investors to sell foreign assets and bring them home, a move incentivized by a stronger currency, higher interest rates, and what's already a 27% gain in Japanese stocks this year. So there are a number of reasons why you could see a sell-off in foreign assets as all that money, maybe not all of that money, but even a portion of that money comes home on the outlook for better returns domestically.
So as we look at some of the different actions that central banks are taking, I know you also note what we see with Canada, Australia, as well as UK with that surprise inflation drop coming again in November then. What should people look at when they're thinking of the risks that could upend the central bank getting to its 2% target?
There are a number of them. And I think, a very tight labor market is something that I don't want to set aside here. The fact that we continue to see wage gains, even in a country like Japan, where, inflation has remained so low for so long. You had Nintendo put in a 10% pay increase, Toyota, Honda, 5% pay increases, Uniqlo, its parent Fast Retailing, talking about up to 40% pay increases. These are sticking, and this is something that the government wants to see in Japan. So it's encouraging businesses to increase wage gains, but we've seen it around the world. And I think that is one thing that could remain sticky with regard to inflation. I mentioned the transportation bottlenecks, but we haven't seen supply chain problems in a couple of years. But the Panama Canal moves 40% of world cargo traffic. And moving through the Red Sea, the strait there, the Bab el-Mandeb Strait, moves 12% of the world's cargo and oil. So these maybe 50% of the world's cargo traffic being blocked up essentially by February could mean some shortages begin to develop and support prices. So there's a variety of factors out there. I'm not saying they're my base case that inflation shoots back up again, but I think the market completely discounting any possibility of that is going a little too far.
We'll certainly be continuing to track that. Appreciate you joining us with your insights. Jeffrey Kleintop, Charles Schwab, Chief Global Investment Strategist. Thanks so much. All right, taking a look at Google restructuring its ad sales department. That's according to a report by The Information. It's unclear if the restructuring would include layoffs. The plan comes amidst the search engine giant using more machine learning techniques. Now, earlier this year, Google announced plans to cut 6% of its workforce. So no wonder the alphabet is our trending ticker so far this morning. And we've been waiting to see some perhaps deeper impact of what we're seeing with machine learning and advanced AI here taking shape here. But as they mentioned, haven't said whether this would include layoffs, perhaps a reorganization more than anything else, but still showing that Google's still trying to make those cuts, still trying to be leaner and really refocus some of its attention here to machine learning.
Yeah, we're talking about a unit with roughly 30,000 employees, so certainly a pretty significant one. Obviously, ad sales a big driver for Google in terms of revenue there. We should point out, it's not just about the machine learning side as well, even though the Information article specifically cites that. I mean, this is an area that has seen weakness going from last year into this year. They have seen a bit of a bounce back with revenue up 9.5%, but certainly that part of the calculation, but something we'll continue to closely watch there. All your markets action straight ahead. Stay tuned. You're watching Yahoo Finance. Well, it's certainly been an eventful year for Tesla. A lot has happened, both good and bad, that produced an interesting 2023 for the car company. The stock is up almost 110% year to date. But is the EV giant stock a buy, sell, or hold for investors in 2024? For more on the EV landscape in the year ahead, let's bring in Carl Brauer, iSeeCars.com executive analyst. It's all part of Yahoo Finance's 2024 Investor Guide. Carl, it has certainly been an eventful year for the EV space overall. It feels like we're sort of moving from sort of accelerated adoption to a bit of a pause going into next year, maybe a little more cautious moves there. How do you view this setting? How do you see this setting things up going into 2024?
I think that's an excellent assessment, that there has been a bit of a pause, maybe a second look at this industry and how quickly it's moving or not moving. We know that there's been some overcapacity for some of the automakers. They're producing more cars than they're selling. There's been some reduction in future plans to expand capacity and build new plants, or even take some shifts offline for certain vehicles like the Ford F-150 Lightning. I think it's a little bit of a kind of awakening for some of these automakers and the industry in general to just realize that even if EVs are the long-term future, they're not going to get there, and we're not going to get to this dominant role for them at the pace we thought we were 1 or 2 or 3 years ago.
And as we look at what's going to be happening with some of these tax incentives coming off, when you look at Tesla, what does that mean for the competitive space here? When you look at, you have established Tesla, you have some of these legacy brands as well, but you also have some of these startups and people are sort of hopping onto these trends, starting to fall by the wayside.
Yeah, and that's really a big element because the tax incentives that are driving a lot of these sales are shifting around. They shifted a bunch when the Inflation Reduction Act went through, and then they're shifting again on January 1st in some ways that are helpful for some companies and more hurtful for others. It appears that Tesla is going to be losing its tax benefit, the $7,500 credit, on January 1st, which seems odd because it's based on domestic production and Tesla's a very domestically oriented company. I've heard theories from people that suggest there was maybe a planned, maybe they didn't fill out the paperwork right. They want this to happen, telling everyone, oh, we're losing the $7,500 credit on the January 1st. Better buy your car now. And then maybe January 5th, January 10th, there's a application process. Oh, wait, we just didn't dot the right I or cross the right T. We've got the $7,500 credit back. Not that Tesla or Elon would ever, maneuver a stunt like that to sell more cars, but some people are suspecting that could happen.
With that said, though, affordability has been a big issue in terms of adoption. Tesla, a lot more affordable with that $7,500 tax credit. We just showed the market share. 56.5% is what Tesla has right now. How does that shift without those incentives? Who do you think is likely to become a bigger player in 2024?
I think, Ford is pretty well positioned right now. GM needs to be building more cars. They keep launching cars, but not really building them. And then I feel like the Koreans are building some of the best EVs on the market right now, but they don't get the incentive either unless you lease. So it's actually, I don't really see any obvious benefits for any companies. Every one of them is facing some challenges. You've got incentives issues, you've got market issues, you've got pricing issues, macroeconomic factors that are slowing down the purchase of electric vehicles. I don't know. It's hard for me to think who would jump into any vacuum created by Tesla, but I would argue that we've seen Tesla's share, you're saying it's about 56, they're down to about half the market. And of course, they were the overwhelmingly dominant player just a few years ago. Every day, every month, every year, we see more cars entering this marketplace, making them less dominant.
And Carl, as we increasingly look at Tesla, almost more so as a tech company than a car company here, what does that mean in terms of expectations for next year and how it's positioning itself?
Well, they've got the Cybertruck coming, which a lot of people would love to think is going to tap into this highly profitable, massive volume truck market that Ford and Chevrolet and Dodge and Ram have been benefiting from for decades. I don't know if that's really going to work because the truck is very expensive and it looks like it's not very profitable for them, and it looks like they're going to take a while to ramp production. So I feel like they're not going to just be this natural. Plus, we've seen a lot of people in the truck market kind of pull back on buying these trucks. When they started using them as real trucks, they didn't seem as attractive. What I would say is kind of Tesla's ace in the hole or ace in the PowerPoint maybe is the supercharger network. That was a brilliant move for Elon to invest in that. Now we're seeing all the other car companies transition to the plug type that he's got in that supercharger network, and he's starting to open it up to other companies and other cars. He could end up with quite the subscription model if he becomes the dominant player in the infrastructure and power supply field.
Carl, how do you think this recent recall for Tesla affects the brand's reputation?
Recalls are interesting. They cause a big news headlines when they first happen, and they're pretty much forgotten, sometimes between hours or days later. This one particularly, it's going to be done mostly through over-the-air updates while people are sleeping at night. It's a lot of cars, but it's also going to be pretty easy to roll out. And there's been issues with his assisted driving technology, undeniably, but there isn't any massive event that was tied to this one single event that was tied to this issue. So the bottom line is, like so many recalls, it'll cause a lot of news initially, and it'll be forgotten fairly quickly.
And certainly when you're a brand as in the news as Tesla is, it's always going to make more ripple effects than other brands. Appreciate you joining us this morning. Carl Brauer, iSeeCars.com Executive Analyst. Thank you so much.
Thank you.
Well, a tale of two coasts. As we get ready to say farewell to 2023, we want to take the economic pulse on the nation, looking at the East Coast and West Coast. Now, today we're tapping into the state of EV charging infrastructure. Now, the West is leading the charge in this effort, with California, of course, taking the top spot with the most charging ports in the US. And it isn't even close. New York takes the second spot, but California has more than triple the amount of charging ports that New York does. So why does the huge gap in EV infrastructure across the country exist? Well, we have Matt Peterson, Lacey, CEO and President, to discuss this with us. Good to have you on the show here. So it's interesting, as we look at infrastructure charging, it makes sense in the state of California. But New York, where we predominantly don't see people driving as much, more congested cities, it's interesting to see that as taking that second spot. What should we need to know about the dichotomy between the two?
Well, I mean, California, pursuant to your previous conversation, California has been the early adopter for EVs. So we needed to invest in the charging infrastructure, and we've seen that accelerate. In Los Angeles alone, we have over 20,000 chargers in the city that are there for electric vehicles. We just, have seen the sales of cars of EVs in California eclipse 25% across the state. So, they're about 7.9% in the third quarter of this last year across the country. So people need the charging. We've seen that early investment. We've seen things like Electrify America, EVgo, others really begin to invest here. Other companies, Shell Recharge has really been investing a lot of, some of the majors, oil companies have invested as well as BP. And amply, we're seeing this infrastructure be deployed, and it's only accelerating in its pace.
Matt, we're both EV drivers, and you've heard me make this complaint before. If you're not part of the Tesla network, doesn't matter how many chargers there are in LA, it's still a very frustrating experience because there's so many chargers that are not working. Why has reliability been such an issue? And what are the lessons that maybe other states can take away from what we have seen roll out in California?
Yeah. So when a charger gets installed, of course, there's a safety standard that's used for the electrical components in the connection to the utility grid, the distribution system. That's really important. But one of the things people don't think about is when a charger doesn't work 80% to 90% of the time, it's a non-electrical issue. It's a software issue. It's a firmware issue. It's a Wi-Fi connection. It's, the data logger isn't connecting and therefore the system shuts down. So, Elon and Tesla have really perfected their model. At the same time, they want to make sure they have uptime. So it's really critical that all chargers have uptime. But you've seen the move to using the North American Charging Standard, or NACS, that Tesla's pioneered from CCS, which is the predominant charging infrastructure that's been in place before. But per our last conversation, we need to see more uptime of chargers. That's why statewide in California and federally, the commitment is 97% uptime, which is, we're seeing in some markets 30 to 40% of the time some of the chargers are down. And how do we do that? We need to make sure we've got folks that are diagnosing and ensuring that if it's an internet connection or a software upgrade that needs to happen, that it's done proactively, preemptively, that we're anticipating these challenges. And so that's why a company like Charger Help, started by Yvette Ellis and Camille Terry, two Black women from South LA that are out there building a workforce across the country and a software platform using the data to create predictive analytics to really fix these chargers ahead of time and make sure there's uptime for when you show up, it's going to work.
And Matt, obviously California, as you mentioned, they're ahead of the game when it comes to adopting this. But when it comes to, say, some of the states on the East Coast and the public-private partnerships, how key is that going to be to really selling that point when it comes to some of these states?
Well, you're going to see an acceleration of charging infrastructure installation as the federal money from the bipartisan infrastructure law, as well as the incentives for vehicles in the Inflation Reduction Act, as well as also upgrades that are part of the Inflation Reduction Act. You can get if you want to put a charger in your home, you might have to do a panel upgrade. You can have most of those upgrades will be eligible for a 30% tax credit from the federal government now, along with the charging infrastructure. The solar system, if you want to put in a solar system and battery storage. So we're going to see this money really begin to work its way through, meaning that we're going to see these chargers in more and more places. In the state plans from the $5 billion in charging that were made available to the states for infrastructure, for charging infrastructure, primarily along freeways and highways, that's making its way. So we're going to see a surge in charging infrastructure in the East Coast, the Southeast, middle of America. It's not just going to be the coasts that are going to see charging infrastructure. And as we see more people get excited, and once you're in an EV, you never want to go back. If you pass up a gas station, it's a phenomenal experience. And it's a phenomenal experience to drive an EV, let alone the environmental benefits, the lack of a tailpipe, and all the other attributes that help fight the climate crisis that comes with driving an EV.
Matt, it feels like we've sort of seen the first wave of adoption with the early adopters obviously willing to shell out maybe a little extra money because of that very point you made about cleaner cars. But real mass adoption is only going to happen with cars that are more affordable and also access to the chargers. We have seen that it's not often equal. It's more of the affluent neighborhoods that get the chargers in place. As we look to this next phase, do you feel like that's being addressed more? And to what extent are those credits, those subsidies you just mentioned, key to making sure that the charger distribution is more equal?
Yeah, you're going to see more charging infrastructure investment in what is known as disadvantaged communities, lower income neighborhoods that are predominantly Black and brown populations that lack access to chargers. And sort of when you look at early adopters, so you saw the charging go where the early adopters may live or go to work or go to shop. We're going to see that begin to come into other neighborhoods. And who are the pioneers in driving electric vehicles are the TNC drivers, people who drive for Uber and Lyft. We need to get charging infrastructure in place in the neighborhoods they live. So one of the things we're doing and we're seeing more of is how do we put fast charging for that opportunity charge? Because if you're just a regular EV driver, you really don't need a fast charge unless you're on a long trip or you don't have a charger available to you. But we're seeing more penetration into multi-unit dwellings, our apartment buildings. In Los Angeles, there's been over 20,000 chargers across the county installed in apartment buildings alone, and that's going to go up. If you own a home, you can plug into the wall, which is what I do in my house. But you also want to make sure that charging is at workplace, if you're going to the office or where you shop. So, we're starting by really seeing how we get those early adopters of the charging they need. More and more people, if you use an Uber or a Lyft, you're seeing more and more EV drivers, whether it's a Tesla or a Nissan or a Chevy or, for other higher end vehicles sometimes in the mix, if you're using the black option, if you're available to do that. And so we're really seeing that begin to drive penetration of charging. And so it's why we've supported legislation federally and statewide to not only put EV car share in low-income neighborhoods at public housing, but add in additional grants with the other incentives to put fast charging in neighborhoods where the public housing is located, which are predominantly low-income disadvantaged communities. How do we get that charging infrastructure where it's needed next?
You raise a good point about the green option when you take an Uber. I always take it. It's my way of sort of by way of sort of test driving an EV. But I did get to test drive an EV when I had a rental car. It really did change my mind. I'm definitely more sold than I was before. So that user experience is certainly going to be key. Appreciate you joining us this morning, Matt Peterson, Lacey President and CEO. Thank you so much.
Thank you so much for having me.
Well, driving an electric vehicle may be better for our air quality, but apparently not our driving quality. A LendingTree study found that Tesla drivers had a higher rate of accidents than drivers of any other brand of vehicle over the past year, with 24 accidents for every 1,000 drivers. So, Kiko, as a Tesla driver, does this seem accurate?
Well, I should clarify that I have switched over from Tesla, but I'm still an EV driver. And we were talking about this morning, Rochelle, that the acceleration of EVs are really on a whole nother level, right? I mean, I will say, just full disclosure, I probably usually go over the speed limit. You live in LA, 75 miles an hour is a little slow when you're on the freeway. But having said that, I don't know, this study says specifically there are indications that certain types of vehicles attract riskier drivers than others. I'll save my comments on what I think about Tesla drivers, but it's so widely seen here that it's hard to say that everybody drives the same, right? Everybody who owns a Tesla isn't necessarily the same.
It's true. I mean, and it really, as we've talked about, it's more about sort of driver behavior. Perhaps you feel a little more confident to, relax a little bit. Perhaps you have, a few more things distracting you when you're driving. But it might come down to the personality of the drivers, which then shouldn't really be attributed to the cars themselves. I mean, by those standards, your Lamborghini drivers, your BMW drivers should be in more accidents. But then when you think of things like autopilot coming into play and being able to sort of relax a bit more and have your car do more of the work for you, maybe a little bit of that, Tesla complacency and smugness when they're driving. I could see that playing a role.
I don't know. I found myself yesterday getting a little aggressive with the Model Y next to me because I felt like they were coming past me. But we'll save my road rage stories for another day. All your markets action ahead. Stay tuned. You're watching Yahoo Finance.
Shares of General Mills falling this morning after slashing its full-year sales forecast. The packaged foods company warning that price hikes are beginning to weigh on the consumer, leading to lower demand. So how will this impact their pricing decisions in the new year? Yahoo Finance's Brooke De Palma has more on this story. Brooke, a lot of people are wondering, as we're seeing inflation ticking down, why are we not always seeing this reflected in some of these prices?
Good morning, Rochelle. Well, we certainly saw in this General Mills latest quarterly results that consumers seem to be pushing back a little bit and trading around in their basket about what exactly they're buying given these uptick in prices. And it is a top trending ticker on Yahoo Finance this morning after we saw that mixed earnings results with revenue coming in lower than expected. We did see that decline of 4%, largely led by a 4% decrease in volume, offset by a 3% increase in price and mix. And one of the biggest takeaways from this report was that consumers continue to display stronger than anticipated value-seeking behaviors across their key markets, and that is ultimately delaying volume recovery in their categories. We saw that the most within their pet segment here in North America. They saw volume drop 11%, and sales in that pet category here in North America dropped 4%. And when you think about that acquisition that they made of Blue Buffalo back in 2018, they said specifically that food at Blue Buffalo seems to be inelastic. Consumers continue to need to buy that up, but treats is where consumers are swapping around. They said that people are trading to less expensive treats, and if they are still trading, then they're trying to switch around how exactly they might give their animal a treat there. But as you just saw on the screen, that did lead the company to reduce their fiscal year guidance. We do now expect organic net sales to range between down 1% and flat compared to a previous call between 3 to 4% growth. And they said that ultimately reflects a slower volume recovery come fiscal 2024. And as you noted, how does this all weigh into pricing? And do they still have the pricing power that they once had? Well, one analyst on the call asking, would General Mills rather take a little bit of a volume hit and push promotions harder, or would they lean into pricing? On the call, CFO Jeff Harmening weighed in.
In terms of the pricing environment itself, I'm not really going to get into specifics of future pricing. What we do see is that, I think importantly, we see an inflationary environment ahead of us.
And he did note that they expect to continue to see the inflation level at lower or low single digits, specifically when it comes to milk and eggs and within their categories as well. And he also went on to say that, quote this, pricing tends to follow inflation because that's the basis on which we increase prices if we see an inflationary environment. And what we've been seeing all along, Rochelle and Akiko, is really this deceleration of food prices, but not necessarily a decrease. And General Mills certainly looking very closely at that as they bake in contracts going into fiscal 2024 and ultimately make a decision about just how much they can, or even if they will, increase prices yet again.
Okay, we'll see how much pricing power they have. Brooke DePalma, thanks so much for that. Well, ByteDance, which owns the popular video app TikTok, has cemented itself as one of China's internet leaders. Sales surged in 2023 to more than $110 billion US. That's up more than 30% from the company's 2022 sales. Those figures, according to a new Bloomberg report. But ByteDance's strong performance comes amid a weaker economic backdrop in China and escalating skepticism in foreign markets, with some eyeing all-out bans of the app. We should point out, as we said there, Rochelle, these are according to Bloomberg reports. It's a private company. They don't necessarily disclose this, but this is sort of important context in that the question with ByteDance has always been, will they in fact go for an IPO? If that's the case, where would they list? Would it be in Hong Kong, given sort of the regulatory headwinds they face here? The company did recently offer buybacks, $5 billion in buybacks of their shares that valued the company at $268 billion. A bump from their last round of buybacks, but still short of the roughly $300 billion valuation they saw last year.
It's true. As you mentioned, a privately held company. We still don't have details about the profitability of this company, but we know that there's been elevated scrutiny already of TikTok. And so that idea of sort of entering as an IPO, highly unlikely in the US. Don't think there's an appetite for it here, but Hong Kong would be an interesting way to enter into the market. But it really does cement this company's role, as when you look at it and compare it to, say, a Tencent, as one of these domineering tech giants that are really taking place in this space. You do have to wonder, though, if there is an IPO action, perhaps some movement by the Chinese government, even though, of course, some of these entities are also based in Singapore as well. But you have to wonder if there will be some intervention there, if we'll continue to see more companies, more governments, restricting some of their users from being on TikTok as well. So still a lot of gray area here, but at least based on this report that we're seeing from Bloomberg, TikTok moving ahead here, ByteDance.
Yeah, ByteDance likes to say they're two separate companies, right? Douyin is their user base in China, and then there's TikTok, which we all know, which ByteDance likes to say is a company that's based in Singapore, although there's questions about to what extent the parent company has a role in all of it.
Indeed. Well, let's take a look at what we're seeing with markets. All three averages in the green this morning. Now, the S&P 500 just shy of that record set in January of last year. Increasing inflows into ETFs helping fuel the most recent rally. According to Morningstar Direct, more than 70 mutual funds have converted to ETFs since early 2021, and 36 of those have happened in 2023 alone. SPDR S&P 500 ETF has seen the biggest inflows, raking in $20.8 billion, the largest amount since the fund began in 1993, according to Bloomberg Intelligence. To discuss how investors should position themselves going into 2024, let's bring in Cynthia Murphy, ETF think tank director of research. She joins us as part of our ETF report brought to you by Invesco QQQ. Thank you for joining us this morning. So, a lot of people had some of this cash on the sidelines that they had then put into mutual funds, but then seeing them convert it into ETFs, what do people need to know going into the end of this year and heading into 2024 about how to play this smartly?
Hi, it's been a crazy month so far this year. I mean, as you pointed out, the amount of money going into a fund like SPY, the S&P 500 ETF, and some of these large cap equity ETFs has been massive. I mean, I think SPY took in like something like $35 billion in the last week alone. So there's been a lot of positioning going into 2024. Now, it's, what's important to remember here is a couple things. In December, we tend to see big flows into ETFs anyway. Traditionally, not only there's a seasonality to the market where U.S. equities tend to perform well in December. I saw a statistic recently that said 70% of the time, the Dow Jones Industrial Average is up in December, regardless of the market environment. So it's a good time for U.S. equities in general. But then, with the Fed messaging suggesting rate cuts next year, it just ignited this, this enthusiasm for U.S. equities going into 2024. And we've seen a lot of money flow into your classic large cap plays. Big tech remains in favor. All these things that we thought were on the line of fire if that higher for longer tone would come out of the Fed, all of a sudden have this new momentum because there's this expectation that rate cuts will come next year. And then you have a lot of, at this time of year, there's a lot of, tax loss harvesting, things that contribute money to ETFs, positioning ahead of next year. We've seen a lot of money come out of active mutual funds in 2023. Again, if you remember in 2022, we saw $1 trillion leave active mutual funds. Some of that money continues to pour into the ETF space. So it's just all these trends really supporting flows into U.S. Listed ETFs, especially in the equity space.
So, Cynthia, let's break that down. I mean, more inflows coming back into high growth names. How do you play that in the ETF space? What are some ones that investors should be keeping an eye on?
What's interesting about that is that, there's two lines of thought there. One is this space, that high growth, the big tech, the magnificent seven, as they like to say. These are all overbought. These are highly valued. These are positions that are likely to correct. The other train of thought is, 2024 still looks like a risky year. There's a lot of people concerned about a recession still. There's a lot of people concerned about downside, given how much the market has run against all odds. So there's a call for quality. Focus instead in companies, high quality companies. Well, some of these high big tech names are actually high quality names. So you're caught between that. You keep buying these high value businesses, or, and you take heed of the call for quality, which also lands you in some of these names, or you diversify away from them. And that's the decision investors have to make. If you look at a fund like QAL, it's taken more than $15 billion of assets already this year. This kind of positioning of, looking for a little bit of quality, look for economic moat, so a fund like Moat. And we also see one of the classic plays for people who are worried about, things not going perfectly right next year are things like your free cash flow companies, your cash cows, or shareholder yield ETFs, SYLD, high dividend ETFs. Those are all names that, people tend to look for when they're looking for that quality, but they're kind of trying to move away a little bit from the big focus in tech. And we're seeing some of that money chase that.
And so, Cynthia, for people who have sort of feel like they've missed the rally at this point, how should they be approaching this through ETFs? You've seen, obviously, small caps also rallying as well towards the end of the year.
Yeah, BlackRock had an interesting data point a couple months ago that talked about in 2023, we saw more than $1 trillion go into money market cash positions, meaning money in the sidelines. And the expectation is a lot of this money is going to be redeployed into 2024. So it's exactly this moment of where do I put that money to work? We're seeing, a lot of it is going into your core large cap, all market type of plays, not really looking to be too tactical with it if you've been on the sidelines. The small cap is an interesting story because small caps are very, very sensitive to the rate environment. They're very sensitive to access to capital. So there have been a spot that people have been watching for signal on what comes next. When small caps get in trouble, it suggests the economy may not be doing so well and markets may be in trouble ahead. And so they're a good barometer for what happens next. And we've seen the momentum in small caps change over the last month. So it's a spot I would watch carefully if you're not playing in the market yet. But what we're seeing, the preferred method has been for people to just go into your QQQs, your SPYs. A fund that's been really interesting if you're worried about concentration is equal weighted approaches like RSP has been a phenomenal fund. It's performed really well. And it's your S&P 500 stocks, but they're equally distributed. So you're not so much concentrated on your Mag 7. You're not so much concentration risk at the top of the portfolio. So you can dilute a little bit of that core equity exposure with different approaches to the same type of basket of stocks.
Great. Cynthia Murphy, ETF Think Tank Director of Research. Appreciate your time today.
Thanks for having me.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Well, lithium, a key ingredient in electric vehicle batteries, has seen a steep fall in prices this year. Here to make sense of this year's volatility and where we can expect the metal to head in the year ahead, let's bring in Yahoo Finance's Inez Ferre. We should point out, Inez, we talk often about lithium and EVs, but it's in so many devices that we have.
That's right. It's in so many batteries, and we talk a lot about the EV space, mainly because lithium is used in electric vehicle batteries, and it is one of the main critical elements in that battery. And when we talk about the U.S. and the transition into electric vehicles and the energy transition, the U.S. has been making a huge push, giving also credits to buyers of electric vehicles, but those batteries need to be made here in the U.S. or the elements in those batteries need to be extracted from here in the U.S. I spoke to one startup chairman who told me that in 2024, you can expect to hear more about domestic production of lithium. Now, let's back up for a second, because this element is used in electric vehicle batteries, but the price of it has really took a dive this year. It's been very volatile since its highs in 2022. One note is that there is very little transparency about lithium prices because it is not traded on a major exchange, but you do have the China prices, which are made public. And so you saw last year that lithium prices went beyond 70,000 per metric ton. And this year it's now at around 21,000 per metric ton. So quite a steep fall from what we've seen there, from what we can glean of those prices. Again, the prices are now are contract prices, so they go between the producer and the manufacturer, and those are made private. But we do know, for example, that Albemarle, who is one of the few producers here in the U.S. of lithium, they lowered their forecast recently, talking about the declining price in lithium and the slower demand in the U.S. and in Europe as well. But look, according to this chairman that I spoke with, he says that this is really a bump in the road, that the U.S. is moving towards energy independence. It's moving towards battery independence in the future. And what is needed is more infrastructure. And this is the way that the U.S. is going to go. So this, what may happen in 2024, the forecast of some slowing demand, you are still going to have electric vehicles that will be sold next year. And it is projected that the country is going to be moving towards electric vehicle adoption.
We'll certainly continue to track that. Biggest consumers of lithium, China, Japan, and Korea. So we'll see how that affects pricing out there as well. Appreciate you, as always, our very own Ines Ferre. Let's get you a final check of the markets as we head into the noon hour. Still looking at green across the board here, though still relatively flat, especially for the Dow there, just up barely about 23 points. The S&P 500, they're also up just about 3 points there on the day as well. Tech-heavy NASDAQ reaching for more daylight, though, up about 0.25%. But the Dow and the S&P 500 have been touching record highs today. NASDAQ not quite making it just yet. Well, that does it for now. I'm Rochelle Akufo alongside Akiko Fujita. Thank you so much for joining us. Stay with us on Yahoo Finance.